So we'll now begin with the Code of Ethics and the Standards of Professional Conduct, a very important review for all levels of the exam. This review is reading number 1 and reading number 2 of every level. So especially important for level 1 students because it's a very big weight on your exam, the biggest weight on the level 1 exam. And then the exact same review will continue throughout level 2 and level 3 and will continue to be a big part of both these exams as well. For level 2 and level 3 students, you have studied all the points before, so it's exactly the same concepts that we'll be going through. But the problem is that you may get complacent about this topic because you've studied it at level 1. So it's important that you don't neglect it and you don't miss out on it because it's still a very big weight on the exam. It is my weakest part of the CFA exam. I find this review to be the toughest, primarily because it cannot be taught as derivatives or fixed income or financial reporting can be. So whatever is numerical can be easily taught. You can tell a method, you can learn that method and you can apply it. With ethics, a lot of areas are gray. So there's no right or wrong. It is about judgment. There is no prescribed rules that you can tick and answer the question. So definitely a lot of mistakes happen. A lot of times you may disagree with the curriculum. So it's not about being a good person or not. So when we think of the word ethics, you would generally imagine that if he is a good person or he's an ethical person, he'll score well in an ethics paper. That's not the case. So it's my weakest section, not because I'm a particularly bad person or anything like that. It's just that you have to learn what a good person means according to the definitions of the CFA Institute. So again, it looks easy to read. It looks easy to understand. There'll per se be no complication as such when I take you through the topics. Whatever examples you do or we'll do in this session, you'll understand pretty much. However, the only way to master this topic is not to read the curriculum again and again or to read the notes again and again from whatever you're following. The idea is to devour your question banks and devour all different types of cases that there may be or different ethical situations there may be that somebody can potentially be confronted with, and hope one of the questions that you solved or that type actually comes up on the exam. So we'll go through it, understand the standards broadly, it will not be a problem, focus on the questions and please go back and start practicing vigorously. So the members of CFA Institute, including charter holders and candidates of the CFA resignation, must act with integrity, competence, diligence, respect, and in an ethical manner with the public, clients, prospective clients, employers, employees, colleagues in the investment profession, and other participants in the global capital markets. So this is what the code, or these 6-7 points, broadly summarize or encompass what the Code of Ethics is about and what it wants us to do. Thereafter, we will see some guidance on specific cases and specific items that the Institute also provides us. But broadly speaking, we want to act with integrity, competence, and diligence. You should place the integrity of the investment profession and the interests of clients above your own personal interests. Again, more details to follow. Use reasonable care and exercise independent professional judgment when conducting analysis, making recommendations, taking investment actions, and engaging in other professional activities. Use care and independent professional judgment. Practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and on the investment profession. Promote the integrity of and uphold the rules governing capital markets. And finally, maintain and improve your own professional competence and strive to maintain and improve the competence of other investment professionals, your colleagues, your subordinates, even your superiors. The standards of professional conduct, which sort of give us references of what to do and how to behave in various situations so as to act according to the Code of Ethics or in line with the Code of Ethics, are organized into 7 standards. Professionalism, and we'll see each of them in a lot more detail. Integrity of capital markets. Standard 3 is duties to clients, duties to employers, investment analysis, recommendations and action, conflicts of interest and the guidelines therein, and your responsibilities as a CFA Institute member or a CFA candidate. Now please note, you do not need to per se remember the numbers of each of these standards. If you practice enough questions broadly, at least these 7 standards and their numbering you will have in your mind. That is, standard 1 is professionalism, 2 is integrity of capital markets, 3 duties to clients, 4 to employers, 5 analysis, recommendations and action, 6 relates to conflicts of interest, and 7 to responsibilities as a CFA Institute member or CFA candidate. However, even if you forget the numbering exactly, I don't think it will be an impediment on the exam per se, because most questions across levels will generally require you to make a judgment as to whether there is a violation or not. And if there is a particular standard, that standard will normally be given with the details in the question. So even if you don't remember the number, it will not be a big impediment. However, these 7 numbers you can try and remember. We'll now look at each of the standards in detail and do some questions as to how it will be tested on the exam. So standard 1 was professionalism. Within professionalism, we are first and foremost required to have knowledge of all applicable law. I did not know cannot be an excuse for violation of ethical behavior. So you should have complete knowledge of the law. More specifically, members and candidates must understand and comply with all applicable laws, rules and regulations of any government, regulatory organization, licensing agency or professional association. For example, the CFA Institute Code of Ethics and of Standards and Professional Conduct governing their professional activities. In an event of conflict, members and candidates must comply with the more strict law, rule or regulation. Members must not knowingly participate or assist in and must dissociate, a very important word, must dissociate from any violation of such laws, rules or regulations. Now once again, we do not need to memorize each of the subpoints, or we don't need to memorize what this whole thing is about and many of the recommendations and guidances that I'll go through. Unlike JIPS for level 3, wherein you have to memorize because that point may be asked and you have to point out, in the case of ethics, just a broad understanding is enough and the important points are enough. You don't need to memorize this as long as you understood what he's trying to say or the spirit of the standard. That is much more important. So dissociate means that as soon as you are aware of any violation or potential violation, first thing to do is you must not be a part of whatever activity is happening anymore. Now you are not required by the standard to report everything to the police or report everything to the regulator. However, you must dissociate yourself, and generally it is always a safe option to take help of a counsel, take help of the compliance officer, take help of an independent legal authority to decide what should be the next step. So standard does not require reporting or taking legal action per se, but standard definitely does require you to dissociate yourself. We'll understand in more detail how this standard can be tested. So if there is a conflict between the CFA Institute standards and the legal requirements or the law, members must know the laws and regulations relating to their professional activities in all countries in which they conduct business. Members must comply with applicable laws and regulations relating to their professional activity. Do not violate code or standards even if the activity is otherwise legal. Always adhere to the most strict rules and requirements. That is, whatever is stricter. If the law is stricter, you will follow the law. If the code is stricter, you will follow the code. And what does the code say? We'll study in the coming slides. Members should not dissociate or separate themselves from any ongoing client or employee activity. Rather, should dissociate or separate themselves from any ongoing client or employee activity that is illegal or unethical, even if it involves leaving an employer. While a member may confront the involved individual first, he must approach his supervisor or compliance department. inaction with continued association may be construed as knowing participation in the activity. So with every standard, we will first read the standard. We will then read what the standard is specifically saying for employees or for firms or for supervisors. And then we will read some recommended procedures that will help us abide by these standards and the laws. So for knowledge of the law, that is standard 1A, it is recommended that members should have procedures to keep up with the changes in applicable laws, rules and regulations. So some process you should have of updating yourself. Compliance procedures should be reviewed on an ongoing basis so as to assure that they address the current law, CFA standards and regulations. If you are the CEO of the firm or if you are the compliance officer, then you must have to, or you must put in procedures for the company as well. Members should maintain current reference materials for employees to access in order to keep up to date on laws, rules and regulations. Members should seek advice of counsel on their compliance department when in doubt. Now please note, these are not requirements. A requirement is you should follow the law. These are just some recommendations that will help you meet those requirements. So if this is being violated, it is not a violation of the standard per se. So please do not get confused. These are just recommendations, is what you should do. And that's why I'm saying that reading and memorizing these is a lot less important than practicing questions on your own and understanding what the different situations are. Okay, so do not over construe the meaning of any of these recommendations. This is just to help you follow the standard. Members should document any violations when they dissociate themselves from prohibited activity and encourage their employers to bring an end to such activity. There is no requirement under the standards to report violations to governmental authorities, but this may be advisable in some circumstances and required by the law in case of others. Members are strongly encouraged to report violations of the code and standards to the CFA Institute as well. For the firms, you should develop and adopt a code of ethics. Make available to employees information that highlights applicable laws and regulations. Establish written procedures for reporting suspected violation of law so that employees can easily report and present any violations, regulations or company policies. Members who supervise the creation and maintenance of investment services and products should be aware of and comply with the regulations and laws regarding such services and products, both in their country of origin and the countries where these services will be sold. Michael Allen works for a brokerage firm and is responsible for an underwriting of securities. A company official gives Allen information indicating that the financial statements Allen filed with the regulator overstate the issuer's earnings. Allen seeks the advice of the brokerage firm's general counsel, who states that it would be difficult for the regulator to prove that Allen has been involved in any wrongdoing. It's not an exam question per se. You are asked to recommend that what should Allen do. Now, in such a case, if he does nothing, that is, if he does not report it to anyone, now he is not required to directly go to the regulator and report a complaint, but he should definitely tell his supervisor that the earnings that we have presented for the IPO have been overstated, that is, earnings are incorrect, and if we let them go, then we will be presenting something that we don't believe in or something that we know is overstated. The compliance officer is definitely in a violation. So if asked, is the compliance officer in violation by telling him it is difficult to prove anything, or if he is recommending that he do nothing, then he is definitely in violation. However, if he is being asked that will it be difficult to prove or not, because it's an estimate at the end of the day. So legally, Allen may not be in trouble, but ethically, he should inform his supervisor and follow the compliance principles as to whatever needs to be done. So if need be, the firm should then inform the regulator about the overstated earnings. So it is recommended that members seek advice of a legal counsel. Reliance on such advice does not absolve a member from the requirement to comply with the law or the regulation. Alan should report the situation to his supervisor, seek an independent legal opinion, and determine whether the regulator should be notified of the error. Kamisha Washington's firm advertises its past performance record by showing the 10-year return of a composite of its client accounts. A composite is simply a collection of portfolios. So all mid-cap portfolios of my firm would normally be aggregated into one composite. So all mid-cap portfolio, this is the mid-cap composite consisting of all a large-cap composite, so on and so forth. However, Washington discovers that the composite omits the performance of accounts that have left the firm during the 10-year period, and that this omission has led to an inflated performance figure. So it must have happened that some accounts we were not able to perform as well, and those accounts left. Now, if I do not include that performance in my presentation, then that is called the survivorship bias, and my returns will be inflated upwards because the bad performance is not included and all the good performances included in my presentation. Washington is asked to use promotional materials that includes the erroneous performance number when soliciting business for the firm. So again, first of all, Kamisha should not solicit business. So first thing is she should disassociate herself because she knows that this is a violation. In the extreme case, if she is being forced, the standard also requires you to leave the employer if you're still being forced. So again, you should go to the compliance, you should inform your supervisor. If the supervisor is not willing to listen, you should inform your supervisor. You should go again, seek an independent legal opinion. Seeking an independent legal opinion is never the wrong choice. Okay, so if that is an option, that is always recommended or can always be done, and go to the compliance decision. But she must not herself participate in any dissemination of the. Immediately she should do that. Misrepresenting performance is a violation of the core and standards. Although she did not calculate the performance herself, Washington would be assisting in violating if she were to use the inflated performance number when soliciting clients. She must dissociate herself. She can bring the misleading number to the attention of the person responsible, her supervisor, or the compliance department. If a firm is unwilling to recalculate, she must refrain from using the misleading promotional material and should notify the firm for her reasons. If the firm still insists that she use, she should consider whether her obligation to dissociate from the activity would require her to seek other employment. An employee of an investment bank is working on an underwriting and find out that the issuer has altered their financial statements to hide operating losses in one division. These misstated data are included in a preliminary prospectus that has already been released. Again, a similar situation. So he is aware that something is in compliance and is being disseminated. So immediately he must at least make an attempt to bring it to the notice of all concerned parties. If no action is being taken, then she can take further legal opinion or decide what has to be done. First step always would be to disassociate yourself from the activity. So anything that you are required to do with this report or with this erroneous data, then you should stop doing the same, and then you should also bring it to the notice of whoever is the authority around you, the compliance department or the supervisor. The employee should report the problem to the supervisors. If the firm doesn't get the misstatement fixed, the employee should dissociate from the underwriting and further seek legal advice on whether he should undertake additional reporting or other actions. Note down your doubt. If you have raised your hand and I've asked you to put your hand down, just note down your doubt. Okay, I'll take it later on. Laura Jameson, I want you to first go through all the possible items, okay, so that it will automatically get cleared. A lot of the different cases we'll present ourselves. So you may be thinking, what if this happens? What if that happens? A lot of the doubts in ethics over the years I've seen is, what if this happens? What if the question had this? What if the question had that? Never mind that, okay? There is no end to the what ifs. First, understand this, and then thinking about the what ifs or even taking my recommendation on the what ifs, let me tell you, is dangerous. Because I myself may be wrong, because a person is only as good as in ethics as many questions as he has solved. When I went into my exam, I had solved 500 questions, I remember, on level 1. Level 2 I ignored it, that's why my performance was very bad on ethics. Even level 3 performance came back because of the level 2 I realized that you cannot ignore ethics. So what I feel will also be recommendatory in nature, guys, because even I don't know. Okay, it's not give me a derivatives question is a 100% guarantee that I'll solve it, I'll give you the right answer. If the question is correct, there's no way. I mean, I can be fairly confident with all my experience now that if it's correct, it will be solved. A question on reporting similarly. On question on ethics, my answer may very well be incorrect, because I myself get surprised. A lot of times I think it's not a violation, it is a violation. And then I go overboard. I think everything is a violation, then you realize it is not a violation. You will remember this and you will realize this for yourself only when you solve questions on your own. So the idea here is just to take you through the whole thing, to tell you that's nothing difficult, and to take you through what the curriculum at least basically wants to say. And then you have an excellent question bank at your disposal. Go and solve all questions. If there is a doubt in a particular question that you think this is incorrect or this is where I disagree with, definitely please email it across. I mean, it is always helpful if there is some mistake in the question, and I will give you my opinion. I will give you other faculty's opinion also on whether they think it is a violation or not. But remember, the trick is always going to be practice, practice, practice in the case of ethics. Laura Jameson, a US citizen, works for an investment advisor based in the US and works in a country where managers are prohibited from participating in IPOs for their own accounts. Now, here's an example of a conflict. The institute only requires that oversubscribed IPOs the employees cannot take in their own accounts. So an IPO is an initial public offering. When a company lists for the first time, people subscribe to an IPO. That is, they want so many shares. If it is undersubscribed, that is, the company offered 100 shares, the whole client list, everybody wants to buy only 80. So 20 shares are remaining. They may be allocated to employees. But if the IPO is oversubscribed, there are 220 shares, then the firm can allocate the shares to the employees. In this case, however, the country's laws don't even allow that. Country's laws simply say that the employees of the investment banker or the employees of the issuing or the broking firm who is involved in the IPO cannot subscribe to IPOs. So in this case, even if it is undersubscribed, the law requires you cannot subscribe. So you will follow the stricter of the two regulations. The code of ethics in this case is laxer as compared to the requirements. So she must comply with the strictest regulations. So in this case, it means that she must not participate in any IPOs for her personal account. Junior portfolio manager suspects that a broker responsible for new business from a foreign country is being allocated a portion of the firm's payments for third-party research and suspects that no research is being provided. He believes that the research payments may be inappropriate and unethical. Now please understand, the investment sector, broadly speaking, is divided into two categories. There is the buy side. The buy side includes all investors. That is, it would be hedge funds, mutual funds, proprietary trading desks, high net worth client, separately managed accounts, pooled accounts. These are all people who are investors. Doesn't necessarily mean they buy stocks only. Okay, they can be long or they can short. Buy implies they buy services. They pay commissions, they pay brokerages, they buy research and transaction services from the sell side. Sell side primarily includes brokers and dealers, investment banks are all sell side institutions. The sell side sells its services to the buy side. Now, as a sell side analyst, you may be doing the same work. your job is also analyzing stocks, giving buy and sell recommendations, writing research reports that the buy side analyst or the buy side fund manager will then read, evaluate, discuss with you, and then decide whether he wants to take any investment action or not. When the buy side trades, or whenever they trade, they normally go or trade through a broker or a dealer, and the broker or dealer gets a commission for assisting in the transaction and often for providing the research and the services to the buy side. Now, there are special standards also that you'll study in level 2 as to how you should use this research and how you should allocate these payments. However, the sell side, or there is a conflict of interest, the sell side may want to influence the buy side manager's trades. So if you see any indication that the buy side fund manager is not trading purely based on the services and the recommendations and the research, however, he is getting any personal gains, and because of which he is choosing a particular trader or a particular broker, then that is a violation often of the legal requirements also, and definitely a violation of the ethical standards. So we'll see many cases wherein we see that there may be some indication of an influence. So if there is any influence or anything like that, then we have other standards also, but we have to be careful, and normally it will be a violation of the ethical standard. So in this case, the junior portfolio manager feels that the broker is not providing any service and still he is getting commissions from our firm, and hence he feels there may be a violation of the ethical standards and also of the legal requirements probably. The question is, what should he do? Again, he must report. If he does not do anything, it may be construed as knowing participation. So once again, he must inform his supervisor, inform the compliance department, and see what action should be taken. So he should follow his firm's procedures for reporting possible unethical behavior and try to get better disclosure of the nature of these payments and any research that is being provided. Standard 1B relates to independence and objectivity. So members and candidates must use reasonable care and judgment to exercise independence and objectivity in professional activities. Members and candidates are not to offer, solicit, or accept any gift, benefit, compensation, or consideration that would compromise either their own or someone else's independence and objectivity. So you should be independent in your views, in your analysis, and you should be objective. The guidance for the standard is that do not let the investment process be influenced by any external sources. Modest gifts are permitted. As we discussed, the sell side may be inclined to give gifts to the buy side professionals so that they trade through their firm and give them more commission. Allocation of shares in an oversubscribed IPOs to personal accounts is not permitted. Distinguish between gifts from clients and gifts from entities seeking influence to the detriment of the client. So if the client gifts you, generally it will not be as big a problem as when the broker gives you a gift, because broker probably seeks to influence you so that you trade through him to the detriment of your clients. Whereas if the client gives you a gift, normally it will be for a good performance or for a good relationship. Generally there will not be a big conflict of interest as long as that client does not seek any special favors, or if you think the client is giving you gifts or there may be reason to suspect that your objectivity can be hindered or your independence can be hindered because of this gift, then again it will be an ethical violation to accept that gift. Gifts must be disclosed to the member's employer in any case. So whether small or big, small gifts you can accept, but even a small gift you must disclose that I accepted this small gift from this person or this client. For investment banking relationships, do not be pressured by sell-side firms to issue favorable research on current or prospecting investment banking clients. Now understand how the sell side is also structured in a little more detail. So every brokerage house today, every big house, JP Morgan, Goldman Sachs, Edelweiss, whatever name you would have heard of, generally would have two departments. there would be an investment banking department, and there would be a broking department or an equities department or a fixed income department. So there'll be a pure play broking business and there'll be an investment banking business. The two have to be completely isolated. They have to be separate. The access should not be provided to investment banking person to the broking floor. The broking floor should not have access to the investment banking floor. They should definitely not sit on the same floor or together. So that investment banking should not influence broking. The investment banker would generally have the requirement to fund new business, new IPOs, new private companies that he wants to take public, because this is big business. Generally, when the investment banker takes a company public, anywhere between 4 to 10% of the money that was raised comes directly to the investment bankers. Now, investment banking is also becoming very competitive. That is, there are so many investment bankers and everybody wants to convince the client to do the IPO through them. The investment banker assists in all the research, etc. But there are many people now who can do the same, and with the advent of technology, etc., dissemination of information is also very easy. So the banking industry per se has become very competitive. Now, in such a situation, the banker may often promise the company that if you do the IPO through us, our broking department will issue favorable research. The broking department does not do new IPOs or does not do transactions, big M&A transactions, etc. That is all done by the investment banking department. The broking department assists these buy-side institutions, that is the hedge funds, mutual funds, etc., in buying and selling of securities. That is generally in the secondary market. So stock has fallen, they would want to issue a buy recommendation. If the stock has gone up, they would want to issue a sell recommendation, so on and so forth. The broking analyst should be not influenced by the investment banking. That is, his recommendations should again be independent and free from any pressure. The investment banking team may put pressure on the sell side analyst to issue favorable research so that that client, that is the company, should do the IPO through them and gives them big business. The commissions in broking would generally be a very small percentage as compared to these numbers that banks would give for IPOs and such activities. Hence, there is a conflict of interest. That is, the broker, he wants to service his client, that is the buy side, but he also knows that his firm gets more income if the investment banking relationship is good. And at the end of the day, everybody's salary is in some way or the other linked to the overall profitability of the firm. So the broking analyst also knows that if we don't get investment banking business and we don't get good business, then the firm's profitability may not be as good, and hence his bonus would not be as good. So the broker may be pressurized to issue favorable research. So you must be careful, and the sell side analyst must ensure that his reports and his analysis is still independent and not influenced by investment banking relationships or anything else. So do not be pressurized to issue favorable research on prospecting investment banking clients. It is appropriate to have analysts work with investment bankers in roadshows only when the conflicts are adequately and effectively managed and disclosed. Be sure there are effective firewalls between the research, investment management, and the investment banking activities. For public companies, analysts should not be pressured to issue favorable research by the companies they follow. Do not confine research to discussions with company management, but rather use a variety of sources, including suppliers, customers, competitors. Because if you just talk to the company will always say the prospects are very good. So if you keep putting a buy rating by discussing with the management, then that is an incorrect thing to do. Buy-side clients may try to pressurize sell-side analysts. So portfolio managers may have large positions in a particular stock. And if he downgrades, the sell side guy puts a sell on that stock, then that may have an effect on the portfolio performance. So as a portfolio manager, there is a responsibility to respect and foster intellectual honesty of the sell side research. Members responsible for selecting outside managers should not accept gifts, entertainment, or travel that might be perceived as impairing their objectivity. So an economy class ticket, if there is no other alternative to go to that place, may be accepted. But if you're accepting first class travel on the expense of the fund manager, so if you are trying to evaluate 3 fund managers and you have a pension fund, or your company has a pension business that has to be given to either one of the 4 fund managers, then you cannot be accepting favors from any one of these fund managers, because clearly it will impact your independence. Members employed by credit rating firms should make sure that procedures prevent undue influence by the firm issuing the securities. Members employed by credit rating firms should make sure that procedures prevent undue influence by the firm issuing the securities. Members who use credit ratings should be aware of this potential conflict of interest and consider whether independent analysis is warranted. So once again, credit rating are issued by credit rating companies generally on the request of the issuer. So if I'm issuing debt, then I can go to a credit rating agency and he will issue a rating based on whatever analysis he thinks. So again, the credit rating agencies are also competing in the market, because there are many credit rating agencies for the companies to get their issues rated by the particular credit rating agency or by them. So once again, if you are influenced as an analyst working in a credit rating agency to issue favorable reports, then that will be incorrect. There will be a violation of the ethical standards. Similarly, if you are an investor who is using reports of credit rating agencies, you should be also aware of this conflict and exercise independent diligence, that not just blindly invest based on the credit rating AA or AAA or whatever it may be. Issuer paid research is fraught with potential conflicts. So if I am Tata Steel or I am Microsoft and I hire a company to write a report rating on myself or write a report on my company, now obviously I'm not going to pay him for writing an adverse report, or there will be ways in which I will influence him that if you're writing a report for my company, it will be a favorable report. So these kind of issuer paid research, please remember, definitely has a lot of conflicts of interest. So analysts' compensation for preparing such research should be limited, and the preference is for a flat fee without regard to the conclusions or the report's recommendations. So if you give a buy rating, I'll pay you $10 million. If you put a sell rating, I'll pay you nothing, will not be the correct way to go about it. Best practice in case of travel is for analysts to pay for their own commercial travel when attending information events or tours sponsored by the firm being analyzed. Of course, if you're going to remote areas which are not accessible, where the company may have its mining operations or plants, etc., and there may not be hotels and accommodation available, then it is okay for you to use the services or to use the facilities provided by the company, however in a reasonable manner. Extravagant services you should decline because they may affect your independence. Recommendations are to protect the integrity of opinions, make sure the opinions are unbiased, create a restricted list and distribute only factual information about the companies on the list. Restrict special cost arrangements, that is, pay for your own commercial transportation and hotel. Limit use of corporate aircraft to cases in which commercial transportation is not available. Limit gifts to token items only. Customary business related entertainment is okay as long as its purpose is not to influence a member's professional independence or objectivity. So if you're going out on a lunch or if you're going out on dinner, it's fine as long as you're not having an expensive or too extravagant an expenditure and your independence and objectivity is not being influenced. Firms should impose clear value limits on gifts. So to tell the analysts that gifts more than $200 are not acceptable or more than $100 are not acceptable. Restrict employee investments in equity IPOs and private placements. require approval of IPO purchases. Review the procedures, have effective supervisory and review procedures. Again, these are recommendations, okay? These are not requirements. The standard that we discussed earlier is what in spirit should be followed in all questions and whether you want to decide there is a violation or not. Firms should have formal written policies on independence and objectivity of research. Firms should appoint a compliance officer and provide clear procedures for employee reporting of unethical behavior and violations of applicable regulations. We'll understand with examples in more detail. So Stephen Taylor, a mining analyst with Bronson, is invited by Precision Metals to join a group of his peers in a tour of mining facilities in several western US states. The company arranges for a chartered group of flights from site to site and for accommodations in Spartan motels, the only chain with accommodations near the mines for 3 nights. Taylor allows Precision Metals to pick up his tab, as do the other analysts, with one exception, John Adams, an employee of a large trust company who insists on following his company's policy and paying for his hotel room himself. Now, Stephen Taylor is the analyst and the company he's analyzing is Precision Metals. Precision Metals essentially has arranged this whole tour for all analysts that please come evaluate my company, evaluate our sites and then write your reports. Now, the facilities may be in far-flung areas, so there is no other motel accommodation available except this. And everybody is using the company's corporate aircraft, which the management also probably would be using to travel from site to site. In this case, there is no ethical violation. Even though he's letting the company pick up his tab for the motel bills or the whatever food he's having, it's a acceptable limit or it's a reasonable expense. John Adams is being extra careful. So he does not want to, or he wants to completely avoid any semblance of a conflict. So that is okay, he's being extra careful, but that does not mean that the other analysts are in violation. So this is where the questions become difficult and the ethical standards become difficult, because there is no numerical value as such that the CFA Institute prescribes as to what is reasonable or what is not. Somebody would argue that motel accommodation for so many days is a big expense and he may be required to, or he may be violating the standards. So as you solve more and more questions, you'll understand better as to what the institute thinks is acceptable and what the institute thinks is not acceptable. In this case, please understand, there is no ethical violation. This is considered reasonable. If on their exit, they were all given expensive gold watches as a thank you gift or a token, then that would be a violation. You can take their corporate aircraft because there's no other option. You can take a small motel, but you can't accept the gold watch as a gift. Walter Fritz is an equity analyst with Hilton Brokerage who covers the mining industry. He has concluded that the stock of metals and mining is overpriced at its current level, but he is concerned that a negative research report will hurt the good relationship between metals and mining and the investment banking division of the firm. In fact, a senior manager of Hilton Brokerage has just sent him a copy of a proposal his firm has made to metals and minings to underwrite a debt offering. This is an investment banking relationship. Underwriting means he is the banker or he is going to sell that issue to other participants in the market. Fritz needs to produce a report right away and is concerned about issuing a less than favorable rating. So again, he is an equity analyst. He thinks the company, metals and mining, is overpriced. He wants to issue a negative report. Just as he was about to do that, he gets information of some investment banking business. He knows if he issues this report, the investment banking business will go to some other company and his company will be at a loss. Now, if he brings out the report as is with a good rating, then it is definitely an ethical violation. What we can recommend Fritz is, if you have to issue a report, then you will have to issue the less than favorable report regardless of whatever investment banking relation should be happening. A good idea in such cases normally is to put the stock on a restricted list. That is, tell all participants that we are not issuing any report on the stock because we have an investment banking relationship. We may be conflicted at the moment. So for 3 months, please do not use our research on this stock, use somebody else's research. But if you give out a rating with a, or you give out a report with a good favorable rating, then that is definitely an ethical violation. Tom Wayne is the investment manager of the Franklin City Employees Pension Plan. He recently completed a successful search for firms to manage the foreign equity allocation of the plan's diversified portfolio. He followed the plan's standard procedure of seeking presentations from a number of qualified firms and recommended that his board select Penguin Advisors because of its experience, well-defined strategy, and performance record, which was compiled and verified in accordance with the performance standards. So, following the selection, a reporter called to ask if there was any connection between the action and the fact that Penguin was one of the sponsors of an investment fact-finding trip to Asia that Wayne made earlier in the year. The trip was one of several conducted by the Pension Investment Academy, which had arranged the itinerary of meetings with economic, government, and corporate officials in major cities in several Asian countries. Understand what's happening? I'm a US fund. I need a dedicated manager for my Asia fund or for my Asia investments. I'm evaluating many and I picked one firm. It was found out that earlier in the year, I had been a part of a tour that they had arranged for all fund managers to understand and evaluate the Asian markets, the Asian economy, etc. Now, per se, this is not a violation because it's clearly mentioned that the trip was one of several conducted by the academy which had arranged for meetings of economic, government, and corporate officials in major cities in several Asian countries. So they want to promote their country, they want to promote investments in their country, and they, as a part of their marketing activity, are inviting people to meet with officials and show their contacts, so that the Penguin also wants to give every fund manager an opportunity to evaluate them, because how will you pick a fund manager without evaluating them? So just being a part of this tour will not be a violation of the standard, or just as long as you exercise reasonable care in picking the advisor, just because you were a part of his tour that he had conducted for everybody, which others probably would also be conducting, is not a problem. The Pension Investment Academy obtains support for the cost of these trips from a number of investment managers, including Penguin Advisors. The Academy then pays the travel expenses of the various pension plan managers on the trip and provides all meals and accommodations. The president of Penguin Advisors was one of the travelers on the trip. Now, until Walter was just a part or was just using meetings with officials, this was not a problem. The problem comes because the academy is paying for the entire travel expenses, for all meals, all accommodations, and is being sponsored by Penguin Advisors. So either Walter must have insisted that, okay, I'll take the meetings that you are offering because I want to meet these officials and these are your contacts. However, Walter should still have paid for his own flight tickets, where easily a commercial airline service was available, easy accessibility of hotels and everything was there. By taking all means and travel expenses, he has violated the standard of independence and objectivity, because now it can be construed that his independence would be strained because he has accepted these favor, or he's accepted this fully sponsored trip. So although Wayne can probably put to good use the knowledge he gained from the trip in other areas of managing the pension plan, his recommendation of Penguin Advisors may be tainted of the possible conflict incurred when he participated in a trip paid for partly by Penguin Advisors and when he was in the daily company of the president of Penguin Advisors. To avoid violating the standard, Wayne's basic expenses for travel and accommodation should have been paid by his employer or the pension plan. Contact with the president should have been limited to informational or educational events only, and the organization should have been made, or this trip should have been made, a matter of public record. Even if his actions were not in violation of standard, Wayne should have been sensitive to the public perception of the trip when reported in newspaper and the extent to which the subjective elements of his decision might have been affected by the familiarity that the daily contact of such a trip would encourage. This advantage would probably not be shared by competing firms. Competing investment advisors probably would not share this advantage of being with him all the time on the trip. And again, this was definitely a publicized event, as we can guess, because reporters knew about it from newspaper articles. So if it was published in the newspaper, then definitely it must have been a high profile event. And then if it was paid for completely or rather partly by Penguin Advisors, it does indicate some conflict to the independence and objectivity. An analyst in the corporate finance department promises a client that a firm will provide full research coverage of the issuing company after the offering. This is not a problem. She is not promising that I will put a buy report definitely, or I will definitely have a favorable rating. She is just promising that I will cover your stock if you do an IPO through me. It's fine. I have a broking department. Their job is to cover stock. So they will cover your stock also. That is, they will issue ratings on your stock. An employee's boss tells him to assume coverage of a stock and maintain a buy rating. Definitely a violation. A money manager receives a gift of significant value from a client as a reward for good performance over the prior period and informs her employer of the gift. Now, in this case, the standards say this is not a violation since the gift is from a client and is not based on performance going forward. However, the gift must be disclosed to her employer. If the gift were contingent on future performance, the money manager would have to obtain permission from her employer. The reason for both disclosure and permission requirements is that the employer must ensure that the money manager does not give advantage to the client, giving or offering additional compensation to the detriment of other clients. If there is no way that he can detriment other clients, because all the funds are managed together. So even if one client gives a gift, as such independence and objectivity is not hindered or is not interfered with, because all funds of his clients are anyways managed. If there was a conflict like that, then accepting that gift would be unethical. In either case, it must always be immediately disclosed to the employer, and it has to be within the acceptable limit that the employer has set. An analyst enters into a contract to write a research report on a company paid for by that company for a flat fee plus a bonus based on attracting new investors to the security. Again, these kind of arrangements are a violation of independence and objectivity, because if the compensation is based on attracting new investors, then definitely you are more likely to issue a favorable report, because new investors will come if they see a favorable report, and hence that will increase your income. So this is a violation of the standard of independence and objectivity. A trust manager at a bank selects mutual funds for client accounts based on the profits from service fees paid to the bank by the mutual fund sponsor. So if you go to any bank branch, there will often be many products that the bank would be selling. There'd be insurance products, there'd be mutual funds, etc. Now the bank says that I have 3-4 options with me, but I will advise your option only if you pay me the highest profit share or you pay me the highest fees. So These kind of arrangements again are a conflict. They may be legal, but it is a violation of the independence and objectivity standard, because obviously you will be pushing the product that is, or if you are pushing the product not based on the performance or not based on the suitability for the client, but rather on the fees or the highest fees, then that is also a violation of the standard of independence and objectivity. That is, if you are accepting arrangements like this, then these will hinder the independence and objectivity of your employees also, because they will not be objective in their presentation or recommendations. They would rather tilt towards recommending your product. An analyst performing sensitivity analysis for a security does not use only scenarios consistent with recent trends and historical norms. That is, he goes out and does more scenarios also. So he considers worst case, best case, and he does a more thorough research. Does not use only, okay, it's a slightly confusing language. If it was uses only recent trends and historical norms, maybe is not exercising reasonable care and judgment, as we will see. In this case, this is not a violation. Standard 1C talks about misrepresentation. So members and candidates must not knowingly misrepresent facts regarding investment analysis, recommendations, actions, or other professional activities. Trust is a foundation in the investment profession. Do not make any misrepresentations or give false impressions, because a lot of times people will not go and evaluate your performance. If you say we've performed well, we've performed 20% in the last 5 years, and then you say the client should have actually gone and checked. No, you cannot make such statements if you did not actually perform to that extent, because a lot of times people will make their investments based on just what you say to them. So trust is a very important, and they'll trust their advisor and they'll trust what the fund manager is saying is correct. So if you're cheating them, then that is a gross ethical violation. This includes oral and electronic communications. Misrepresentations include guaranteeing investment performance and plagiarism. Plagiarism encompasses using somebody else's work, example reports, forecasts, models, ideas, charts, spreadsheet models, without giving them credit. Knowingly omitting information that could affect an investment decision is considered misrepresentation. So if you're only presenting the good things and ignoring the bad things, then again it is a violation. Models and analysis developed by others at a member's firm are the property of the firm and can be used without attribution. So if your employee has done some work, you don't have to cite the employee's name. A report written by another analyst employed by the firm cannot be released as another analyst's work. So a lot of time I have a lead analyst and I have a subordinate analyst, and the lead analyst has done no work in the new report. Then I should not release the report in the lead analyst's name. As long as he's supervised and seen and read and gone, then it's fine. You can put his name. But the analyst who has actually done work on the report is whose name should be put on the report. A good way to avoid misrepresentation is for firms to provide employees who deal with clients or prospects a written list of firms' available services and a description of the firm's qualifications. Employee qualifications should be accurately presented as well. To avoid plagiarism, maintain records of all materials used to generate reports or other firm products, and properly cite sources in work products. Information from recognized financial and statistical reporting services need not be cited. So if it's from the government website or if it's from a public source that the government has allowed public to use, then it's okay even if you don't cite it. But all other work, if you've taken from somewhere, you must cite the source and give credit to the original publisher or whoever has done the work. Members should encourage their firms to establish procedures for verifying marketing claims of third parties whose information the firm provides to clients. So if I'm a bank and I'm recommending mutual fund XYZ's products, and XYZ are making big claims about what they have done, before I recommend these products to my clients, I should try to see if the claims that they are making are actually true or not. That is also a part of your ethical responsibility. Again, these are recommendations. These are not requirements. So if they don't do that, it's not a violation of the ethical standard, but this is what the standard says they should do. Alison Rogers is a partner in the firm of Rogers & Black, a small firm offering investment advisory services. She assures a prospective client who has just inherited $1 million that we can perform all the financial and investment services you need. Rogers & Black is well equipped to provide advice, but cannot provide asset allocation assistance or a full array of investment services. So this is what is misrepresentation. I can do everything. I have full experience. Is a wrong thing to say when you don't have the expertise and you don't have the bandwidth, you don't have the employee strength. Anthony Maguire is an issuer paid analyst hired by a publicly traded company to electronically promote their stocks. Maguire creates a website that promotes his research efforts as seemingly an independent analyst. That he has done his independent research and he thinks it's a buy, whereas he is not an independent analyst. He has been paid by the companies to write these reports. Maguire posts a profile and a strong buy recommendation for all these companies. He does not disclose the contractual relationship in the report he issues or in the statements he makes about the companies on internet chat rooms. Again, a good example of misrepresentation. So you can issue a report, but you must disclose your relationship and you must disclose your conflict of interest. Claude Browning, a quantitative analyst for Double Alpha, comes in great excitement from a seminar. In that seminar, a well-publicized quantitative analyst discussed one of his new models in great detail. Browning is intrigued by the new concepts. He proceeds to test the model, making some minor mechanical changes but retaining the concept, and produces some very positive results. Browning quickly announces that he has discovered a new model and that clients and prospective clients be informed as ongoing proof of Double Alpha's continuing innovation and ability to add value. Again, if you've retained the basic concept and you've made minor modifications or customizations, then can you pass off the model as your own? You cannot. So he should cite the seminar from where he has taken the model and he should cite the original source of his work. Paul Ostrowski runs a two-person management firm. Ostrowski's firm subscribes to a service from a large investment research firm that provides research reports that can be repackaged by smaller firms for those firms' clients. Ostrowski's firm distributes these reports to clients as its own work. So again, this would be a violation of the misrepresentation standard because Ostrowski did not write these reports and the company is not their employee. If it was their employee, then they don't need to mention because your employee's work is your work. But if you're subscribing to a third-party research, then you should disclose what is the original source of the research. So you can rely on third-party research. However, you cannot employ that you are the author of the report. Member makes an error in marketing materials and misstates the amount of assets his firm has under management. A mistake, please note, is not a violation of the ethical standard, especially a mistake in something like AUM, which keeps fluctuating on a daily basis rather on a every hour. Because as the stock market moves, your AUM will also change. So if you've made a mistake, it's not a problem. You've not violated any ethical standard by making a mistake. However, you should immediately stop the dissemination and try to make an effort to inform the concerned parties and correct the mistake. Stop distribution of the erroneous material as soon. The marketing department states that an analyst has received an MBA degree, but he has not. The analyst and other members of the firm have distributed this document for years. Again, violation of, or he has misrepresented the employee's qualifications. A member describes an interest-only collateralized mortgage obligation as guaranteed by the US government, since it is a claim against the cash flows of a pool of guaranteed mortgages, although the payment stream and the market value of the security are not guaranteed. Again, misrepresentation. Actually, the guarantee is not there. However, the firm is claiming that it is a US government guarantee. So he may think there is a guarantee, but if there isn't, he should check and verify. If there isn't a guarantee, then you cannot tell the clients that it is a guaranteed product. This would be again misrepresentation. A member describes a bank certificate of deposit as guaranteed. This is fine as long as the limits of the guarantee provided by the Federal Deposit Insurance Corporation, or whatever is the insurance corporation of that particular country, is not exceeded, and the nature of the guarantee is clearly explained to the clients, that up till $100,000 or up till $50,000 your money is guaranteed by the government. Beyond that, your money is not guaranteed. So that's fine as long as there actually is a guarantee, you are not misrepresenting. A member uses definitions he found online for terms such as variance, coefficient of variation in preparing marketing material. Now, even though this may not be a legal violation, the Code of Ethics says that if you're taking verbatim these definitions without citing the source from any website, then it will be considered as a violation. It will be considered plagiarism. That is, you're taking somebody else's work verbatim. So even though these are standard terms, using the work of others word for word is plagiarism and will be a violation of the ethical standards. Data from public sources, government websites, etc. can be used. That's fine. But if you're going to somebody's website and using his definition or using whatever he has written, even though it may be a public website, does not mean that you can take his work and put it in your work. A candidate reads about a research report in a financial publication and includes the information in a research report, citing the original research report but not the financial publication. So in this case, the standard requires that since he referenced it from the financial publication, let's say the Economic Times or whatever financial publication that he subscribed to, and which is where he saw this original research by somebody else. So if he's referenced it from that financial publication, he should cite the financial publication as well. So to the extent that the candidate used information and interpretation from the financial publication without citing it, the candidate is in violation of the standard. The candidate should either obtain the report independently and then reference it would be fine. If he relies solely on the financial publication, then he should cite both the financial publication as well as the original research report. That is, so and so report taken from this date or taken from this publication. Members and candidates must not engage in any professional conduct involving dishonesty, fraud, deceit, or commit any act that reflects adversely on their integrity, reputation, trustworthiness, or professional competence. CFA Institute discourages unethical behavior in all aspects of members and candidates' lives. Do not abuse CFA Institute's professional conduct program by seeking enforcement of this standard to settle personal, political, or other disputes that are not related to professional ethics. So just because you don't like your colleague, don't complain against him to the CFA Institute or to any other authority. For the firms to avoid the problem of misconduct, you are encouraged to adopt the following policies and procedures. That is, develop and adopt a code of ethics and make clear that unethical behavior will not be tolerated. Give employees a list of potential violations and sanctions, including reasons for dismissal. Check references of potential employees before getting them on board. Simon Sassaman is a trust investment officer at a bank in a small affluent town. He enjoys lunching every day with friends at the country club, where his clients have observed him having numerous drinks. Back at work after lunch, he clearly is intoxicated while making investment decisions. And this phenomena actually is more common than you would imagine. Okay? So this often happens in investment houses, professional houses also. His colleagues make a point of handling any business with Sassaman in the morning because they distrust his judgment. It's getting recorded, guys. Because they distrust his judgment after lunch. So again, not a question that will really come on the exam. It's too easy, but just to explain what is misconduct. So don't do this, guys, okay? This will be a violation of the standard of misconduct. Carmen Garcia manages a mutual fund dedicated to socially responsible investing. She is also an environmental activist. As the result of her participation at non-violent protests, Garcia has been arrested on numerous occasions for trespassing on the property of a large petrochemical plant that is accused of damaging the environment. Now, this is a trick question. So, it's a legal violation. So, she probably has been arrested also on numerous occasions. So, she has broken the law. However, in this case, it is not an ethical violation. So, the standards do not try to invade on your personal beliefs or on your personal circumstances, as long as they do not reflect poorly on the investment profession or on your capabilities as an investment professional. So, ensure if any personal behavior, for example, the drinking in the previous question, reflects poorly on your professional behavior as well, then it will not be tolerated. If you are dishonest in your personal dealings, that is also a violation of the ethical standard, because if you're dishonest in personal dealings, it's possible you'll be dishonest in professional dealings also. But trespassing because you of some environmental beliefs, etc., are not a violation of the ethical standards. A member intentionally includes a receipt that is not in his expenses for a company trip. Okay, again, this will be a violation. Don't do this. A member tells a client that he can get her a good deal on a car through his father-in-law, but instead gets her a poor deal and accepts a part of the commission on the car purchase. This is again a violation. It is dishonesty in your personal dealings. It reflects poorly on you as an investment profession or investment professional as well. Standard 2 deals with integrity of capital markets. So members and candidates in possession of material non-public information. So standard 2A deals with material non-public information that could affect an investment's value, must not act or induce someone else to act on the information. A highly tested standard and a confusing standard many a times. So if you are in possession of material non-public information, and you may come in possession a lot of times not because of your own fault. So you overheard somebody or accidentally you saw something. If you are in possession, then you cannot trade. You are just not allowed to use that information in any way or trade on that information. You must make an effort, as we'll see in the recommendations, to make it public or to get it disseminated through the right sources so that everybody knows, and then you can trade. Information is material if the disclosure would impact the price of the stock, or if reasonable investors would want the information before making an investment decision. Ambiguous information, as far as its likely effect on price, may not be considered material. So if something is ambiguous, it's hearsay, That's fine. It's not material information. But a written report from the company source signed by an auditor and all material, non-public sources of information generally. Information is non-public until it has been made available to the marketplace. An analyst conference call is not public disclosure. Very important. Just because he did the analyst or just because he did a conference call is not enough. You have to ensure that it's on the company website, or it's been in a newspaper, or it's been publicly disseminated. It's been informed to the exchange is normally the first way the information is disseminated. So results, notifications, all first have to come on the exchange. Then you can discuss the same information on a conference call. But any new information you cannot give on the conference call, or if you're giving, it should be disseminated publicly as well. That is to the exchange in a written notification, through a newspaper, on the website, or in some other manner. Selectively disclosing information by corporations creates the potential for insider trading violations. The prohibition against acting on material non-public information extends to mutual funds containing the subject securities as well as related swaps and options contracts. Very important is to understand the mosaic theory. There is no violation when a perceptive analyst reaches an investment conclusion about a corporate action or event through an analysis of public information together with items of non-material, non-public information. So non-public means private. So if you're using private information, however the private information was non-material and public information, and you collated that information together and you decided that this stock will probably get acquired, or this company will probably acquire this company based on your analysis. It's not based on any material non-public information. Then such a situation will not be a violation of the standards. It is just good research. That is what you are required to do. Make reasonable efforts to achieve public dissemination of the information. Now these are the recommendations. Encourage firms to adopt procedures to prevent misuse of material non-public information. Use a firewall within the firm with elements including substantial control of relevant interdepartmental communications through a clearance area such that a client's or a legal department. So if investment banking has to talk to the research team, then there should be a compliance area in the middle so the compliance person can see what they're talking, and if the investment banking guy is talking to the research person. Review employee trades. Maintain watch restricted rumor lists. So if you are in possession of material non-public information because of private dealings with a corporate, because you are having an investment banking job or something like that, then again you should put it on the restricted list or on the watch list, because you may come in possession very soon, so that you don't trade, or you do not advise anyone to trade on material non-public information. Monitor and restrict proprietary trading while a firm is in possession of material non-public information. Prohibition of all proprietary trading while a firm is in possession of material non-public information may be inappropriate because it may send a signal to the market. In these cases, firms should take the contra side of only unsolicited customer trades. Now, very interesting. If you prohibit all trades, then again it may be an indication, or it may divulge something. So if you're not accepting any buy calls, or if you're not purchasing the stock suddenly, or you start market making, then again at times it may not be appropriate. So in such a case, you should not advise, or you should not talk about that stock. However, you can take the other side of trades that were unsolicited or that people are independently doing. So you are not actively going and selling the stock. You are not allowed to, because you are in possession of material non-public information. Now if somebody comes to you unsolicited, you didn't go out looking to sell, somebody wants to buy independently. In such a case, you may be allowed to sell to that individual because it was an unsolicited trade. Actively selling the stock based on when you are in the possession of material non-public information will definitely be a violation. Again, the standard can get confusing, as I mentioned in the beginning. So see the examples and practice a lot of questions on this standard particularly, so that you understand what is material, what is non-material, what is public, what is non-public, and when in possession of material non-public, what can you do, what cannot you do. Josephine Walsh is riding an elevator up to her office when she overhears the financial officer of Swan tell the president of Swan that he has just calculated the earnings and they have unexpectedly and significantly dropped. She overhears. The CFO adds that this drop will not be released until next week. Walsh immediately calls her broker and tells him to sell her Swan stock. This will be a violation of the Material Non-Public Information Standard. You cannot trade in possession of material non-public information. Earnings of a quarter are material information. They are non-public as is mentioned in the case, hence you cannot trade. Samuel Peter, an analyst with Scotland and Pearce, is assisting his firm with a secondary offering for Bright Ideas Lamp Company. Peter participates via telephone conference call in a meeting with Scotland and Pearce investment banking employees and Bright Ideas CEO. Peter has advised that the company's earnings projections for the next year have significantly dropped. Throughout the telephone conference call, several Scotland and Pearce salespeople and portfolio managers walk in and out of Peter's office when the telephone call is taking place. As a result, they are aware of the drop in projected earnings for Bright Ideas. Before the conference call is concluded, the salespeople trade the stock of the company on behalf of the firm's clients, and other firm personnel trade the stock in a firm proprietary account and in employee personal accounts. So first of all the individuals are in violation, all those who traded, because they were in the office, they heard somebody else talk on the phone, and they were in possession of material non-public information. However, even Peter is in violation for not effectively supervising or not ensuring that if he's doing a conference call which can be material, to do it separately so that everybody cannot so easily hear it. So all participants in this case of the company are in violation of the standards. People who have traded are in violation of material non-public information. Samuel himself is in violation of other standards that we will see. So Peter violated this standard because he failed to prevent the transfer and misuse of material non-public information to others in his firms. Others, or the salespeople, fund managers who traded, are definitely in violation of the standard. Elizabeth Levinson is based in Taipei and covers the Taiwanese market for her firm. She is invited to meet the finance director of a manufacturing company along with other 10 largest shareholders of the company. During the meeting, the finance director states that the company expects its workforce to strike next Friday, which will cripple productivity and distribution. Can Levinson use this information as a basis to change her rating from buy to sell? No, because it is material and it is non-public information yet. Jagdish Teja is a buy-side analyst covering the furniture industry. Looking for an attractive company to recommend as a buy, he analyzed several furniture makers by studying their financial reports and visiting their operations. He also talked to some designers and retailers to find out which furniture styles are trendy and popular. This is non-public information. However, it is non-material. If you went to individual retail stores, the company will have many retail stores. So one retail store and what he says about the trends is not considered material. Although none of the companies that he analyzed turned out to be a clear buy, he discovered that one of them, Swan, might be in trouble. Their extravagant new designs were at substantial costs. Even though these designs initially attracted attention, in the long run, the public is buying more conservative furniture from other makers. Based on that, and on P&L analysis, Teja believes that Swan's next quarter earnings will drop substantially. He then issues a sell recommendation for SFC. Immediately after receiving that recommendation, the investment managers start reducing the stock in their portfolios. This entire case is an example of the mosaic theory, wherein the analyst has combined pieces of non-material, non-public information along with his analysis of public information to make an investment idea or a recommendation. So he concluded earnings will drop. Earnings may have dropped, but that's because of his research, not because of any material non-public information that he was in possession of. So this is not a violation. A member's dentist, who is an active investor, tells the member that he believes Acme Incorporated will be bought out in the near future by a larger firm. The member investigates and purchases the share of Acme. So it's the dentist who told him. This will not be considered as material non-public information. Okay, not everybody would not want to take the dentist's view, and even if the dentist has told him, it's fine. It's not. It may be non-public information, but it's not material. Hence, this is not a violation of the standard. A member received an advance copy of a stock recommendation that will appear in a widely read national newspaper column the next day and purchases the stock. Again, a clear violation because it is material non-public information. A member is having lunch with a portfolio manager from a mutual fund who is known for his stock picking ability and often influences market prices when his stock purchases and sales are disclosed. The manager tells the member that he is selling all his shares in Able Incorporated. The next day, the member shorts the stock. When the dentist told him, it was not a violation. But now, the mutual fund known for stock picking ability, who often influences the market when his prices are or when his decisions are disclosed, would you want to know what this person is doing before you trade? Yes. So if you are in possession of such information, then again you are in the possession of material non-public information. You cannot use it, you cannot trade it, you cannot tell it to others, you cannot disseminate. You have to prevent dissemination of this information. The member has violated the standard by acting on the information. A broker who is a member receives a sell order. The broker sells his shares, but since his personal holdings are small as compared to the stock's trading volume, his trade does not affect the price. So from the previous example, a broker also receives the information and he trades on it. Is he in violation? Whether or not his trade affects the price is not relevant. If he traded on material non-public information, then that will be a violation of the ethical standards. Standard 2B relates to market manipulation. So members and candidates must not engage in any practices intended to mislead market participants through distorted prices or artificially inflated trading volume. Spreading false rumors is also prohibited. The standard applies to transactions that deceive the market by distorting the price setting mechanism of financial instruments or by securing a controlling position to manipulate the price of a related derivative and the manipulation of the asset itself. Spreading false rumors is also prohibited. Sergey Gonchar is the chairman of the Acme Futures Exchange, which seeks to launch a new bond futures contract. In order to convince investors, traders, arbitrageurs, hedgers, and so on to use its contract, the exchange attempts to demonstrate that it has the best liquidity. To do so, it enters into an agreement with members so that they commit to a substantial minimum trading volume on the new contract over a specific period in exchange for substantial reductions on their regular commissions. Now please note, doing promotionary things or doing promotions is not a problem. If I've started a new exchange and I want people to trade and I'm giving them big discounts on the commissions, is fine. However, not disclosing it to the other market participants and making them think that these are regular traded volumes on this exchange would be a violation. You are trying to manipulate the other investors by not disclosing the arrangement. So the arrangement is fine, but to be not in violation, you must disclose it to all market participants so that they know that this volume is only because of the substantially low commissions. If you do not disclose, then you are indulging into market manipulation. If ACME fully discloses, then it is fine. A member is seeking to sell a large position in a fairly liquid stock from a fund he manages. He buys and sells shares of this stock between that fund and another. He also manages to create an appearance of activity and stock price appreciation, so that the sale of the whole position will have less market impact and he will realize a better return for the fund's shareholders. So stock is illiquid. What he's doing is, both funds he himself manages. He starts buying and selling this stock from amongst his own funds. There's no profit or loss because it's he himself who's buying as well as selling. So what this does is it gives the appearance of liquidity. So more investors can also start coming and investing in the stock because they feel it is a fairly liquid stock. Whereas actually, is it a liquid stock? No. So you are manipulating because you're again giving a false impression of liquidity, which may attract investors or which may manipulate investors. A member posts false information about a firm on internet bulletin boards and stock chat facilities in an attempt to cause the firm's stock price to increase in price. Again, a violation. Standard 3, very importantly, will deal about your duties to clients. So 3A talks about loyalty, prudence and care. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of their clients and place their clients' interests before their employers or their own interests. So clients first, employers second, your own personal economic benefits third. Client always comes first. Exercise prudence, care, skill and diligence under the circumstances that a person acting in a like capacity and familiar with such matters would use. So use your expertise, use your knowledge, use your judgment well. Manage pools of client assets in accordance with the terms of the governing documents, such as the trust documents or investment management agreements. Make decisions in the context of the total portfolio. Vote proxies in an informed and responsible manner. Due to cost-benefit considerations, it may not be necessary to vote all proxies. Now please note that in many cases, when corporates take big decisions, they do a merger or they do another announcement, they may often come to shareholders for their approval. Now, if you're managing somebody else's money, then you are required to vote on their behalf. So your investors have not only given you their money to manage, you're also voting proxies on their behalf. Now, it is not necessary that you have to always vote. However, when you are voting, you must exercise reasonable care and diligence. Client brokerage or soft dollars or soft commissions must be used to benefit the client. At level 2, you will see the whole detail on, or you've already seen the whole separate review on soft dollars or soft commissions. But just remember that commissions are a property of the client. Any commissions that you receive, and they must be used to benefit the client. The client may be the investing public as a whole rather than a specific entity or a person. So we'll understand this with more examples. So if you as a fund manager are paying commission to the broker, and the broker in turn provides you research reports, etc., then those reports must directly benefit your clients whose funds you are managing. You cannot use those reports for personal gains, personal benefits, or for other clients or other investments. So whatever research you are getting from the brokerages paid by a particular client need to be used for that client or the benefit of that client. Submit to clients at least quarterly itemized statements showing all securities in custody and all debits, credits, and transactions. Encourage firms to address these topics when drafting policies, procedures regarding fiduciary duty. Follow all applicable rules and laws. Establish the investment objectives. Consider the suitability of portfolio relative to clients' needs and circumstances. The investment's basic characteristics or the basic characteristics of the total portfolio must all be considered to suit the client and accordance with your client. Diversify your funds, do not concentrate them to any one stock or one sector. Deal fairly with all clients in regards to your actions, and disclose any conflicts of interests to your clients. This will come in more detail in the coming standards as well. Disclose any additional compensation agreements that you may have. So trading through one broker, if it's giving you additional benefits, and you should disclose any such arrangement with the client. Vote proxies in the best interest of the clients and the ultimate beneficiaries. Maintain confidentiality unless required by law. Seek best execution. So trade through the broker that is charging the lowest commission and providing the best services, not because or not to the broker who is personally benefiting you or because he is your friend. Place clients' interests first. First Country Bank serves as trustee for the Miller Company's pension plan. Miller is the target of a hostile takeover attempt by Newton Incorporated. So is the Miller Company. The Miller Company has a pension plan. You will study in more detail in the review on financial reporting at level 2, the details of pension accounting. Anyways, so the pension plan is to serve the benefits of the retirees and when these employees retire. So if the pension plan performs poorly, then the interests of these employees and these retirees may be at stake or their returns may get diminished. In attempting to ward off Newton, so there's another company, Newton, that wants to acquire Miller. First Country Miller's managers persuade Julian Wiley, an investment manager at First Country Bank, to purchase Miller common stock in the open market for the employee pension plan. Miller's officials indicate that such action would favorably be received and would probably result in other accounts being placed with the bank. Although Wiley believes the stock to be overvalued and would not buy it, she purchases to support Miller's managers. The heavy stock purchases cause the market price to rise such that Newton retracts its takeover bid. Now in such a case, this action is this action is a violation because the pension plan is being forced to purchase Miller stock so the stock goes up so that Newton does not acquire or it becomes unattractive for Newton. Now in such a situation, the clients of the pension plan are shortchanged. That is, these retirees who are getting the benefits or whoever is drawing the benefits, because once this acquisition attempt goes off, the stock will again come back, or you have purchased an overvalued security at even more overvalued levels to help somebody else or for your personal gains, because what this will do is that whoever is the fund manager here is going to get more accounts, is going to get benefit from the sponsoring company. So your clients come first. Her client now is not the Miller management. Her client now is the pension fund or the pensioners of this pension fund. So she has to act in the best interest of her client or her pension clients. Emily Rome is a trust officer for Pager Trust. Rome's supervisor is responsible for reviewing Rome's trust account transactions and her monthly reports of personal stock transactions. Rome has been using Nathan Gray, a broker, almost exclusively for trust account brokerage, where Gray makes a market in stocks he has been giving Rome a lower price for personal purchases and a higher price for sales than he gives to Rome's trust accounts and other investors. So again, you deal with a broker for your fund, and then that broker assists you in your personal investments also. And it's been found that the personal investments are being given favorable benefits rather than the trust accounts. So again, the client should come first. The client should get the best execution. You should get a inferior price, be it buying or selling. If the other way around is happening, then again it is a violation of loyalty, prudence and care. A member uses a broker that charges relatively high prices and provides average research and execution for client trades. In return, the broker pays the rent and other expenses of the firm. Clearly a violation. So you have to seek best execution rather than the broker that is giving you personal benefits, or is giving the employer any benefit. So employer comes second, clients come first. In return for receiving account management business from broker, a member directs trades to broker X on accounts referred to her by broker X, as well as other accounts as an incentive to broker X to send her more business. So the broker is recommending the fund manager, and hence the fund manager is giving business to the broker. Again, it is a violation because the fund manager has to seek the best execution. Broker X may not be the best execution without evaluating other options. If she is giving the business to broker X, and that's at a detriment to her clients, even though she is personally benefiting because of more business, but his clients are adversely impacted because they are not getting the best execution. A member does more trades in client accounts than are necessary to accomplish goals because she desires to increase her commission income. So please note, commissions will anyways be knocked off from the NAV, or that hit will directly be taken by the client. So if you're trading too much, you're buying and selling a lot of times for not good enough reasons, or just to increase your commission payouts, so the broker may be benefiting you personally or for whatever reason, then again it's a violation of the standard. Standard 3B in duties to clients deals with fair dealing. So members must deal fairly and objectively with all clients and prospects when providing investment analysis, making recommendations, taking investment action, or engaging in other professional activities. Again, an important standard, relatively easy. So you have to be fair. You cannot benefit one client at the expense of the other. So do not discriminate against any clients when disseminating recommendations or taking investment action. Fairly does not mean equally. In the normal course of business, there will be differences in the time emails, faxes, etc. are received by different clients. Different service levels are okay, but they must not negatively affect or disadvantage any clients. So disclose the different service levels to all clients and prospects, and make premium levels of service available to those who wish for them. So give all clients a fair opportunity to act upon every recommendation. Clients who are unaware of a change in recommendation should be advised before their order is accepted. Treat clients fairly in light of their investment objectives and circumstances. Treat both individual and institutional clients in a fair and impartial manner. Members and candidates should not take advantage of their position in the industry to disadvantage clients. Develop written trade allocation procedures. Ensure fairness to clients, timely and efficient order execution, and accuracy of client positions. So do not give yourself the better price, or do not take the good trades yourself and the good IPOs yourself and market only the bad IPOs, or market IPOs that you think are overvalued. So all these actions would be a violation of the standard. Your client's interests basically have to always come first. Give them a fair opportunity. give them fair disclosures, give them the first opportunity, explain to them if they haven't yet read the report, of if they have not understood before they trade or before you accept their order. Encourage firms to establish compliance procedures requiring proper dissemination of recommendations and fair treatment of all customers and clients. Limit the number of people who are aware that a change in recommendation will be made. Shorten the time frame between the decision and dissemination. Publish personal guidelines for pre-dissemination. That is, before you've written the report, you should not be allowed to talk to anybody about it or disclose it to anybody else. Have in place guidelines prohibiting personnel who have prior knowledge of a recommendation from discussing it or taking action on the pending recommendation. So before it has been disseminated, again, nobody should be allowed to use it. Simultaneous dissemination of new or changed recommendation to all candidates who have expressed an interest or for whom an investment is suitable. So at least the email should go to everybody first. So first you email, and then you can pick up the phone and start calling the big clients first, and then go to the smaller client, or not call the smaller clients at all. But at least the dissemination should happen equally and to everybody. So you cannot send one group of investors the report first and send the other group of investors the report later. So simultaneous dissemination or simultaneous mailing of all reports should be happen. Somebody will read it, somebody will not read it, somebody will receive it early, somebody will receive it later. That is fine. But your job is to disseminate simultaneously, and then you can have higher levels of service for bigger clients, etc. Maintain list of clients and holdings to ensure that all holders are treated fairly. Disclose trade allocation procedures. Establish systematic account review. Ensure that no client is given preferred treatment and that investment actions are consistent with the account's objectives. So if it's a purchase order, then whoever has first given the order should be executed first. You cannot purchase it and give it to the people who you think are your good clients and neglect people who gave the order on time, but they are smaller clients, so you don't want to service them as much, or you don't want to allocate the trades to them. Disclose all available levels of service and say that they can be purchased for this much price. A member gets options for his part in an IPO from the subject firm. The IPO is oversubscribed and the member fills his own and other individuals' orders, but has to reduce allocations to his institutional clients. Failure violation: you should first fill your institutional clients and then your own. So other individuals is okay as long as they give it first, or in order, or whatever was a predefined method. But to put your own account before any client will be a violation. Member is delayed in allocating some trades to client accounts. When she allocates the trades, she puts some positions that have appreciated in a preferred client's accounts and puts trades that have not done as well in other clients' accounts. So she was given a sell order by 10 clients for a total of 1000. So she sold 1000 shares. Some were sold at a higher price, some were sold at a lower price. The higher price she allocates to her preferred clients and the lower to not so preferred clients. So this will be a violation of the standard. Because of minimum lot size restrictions, a portfolio manager allocates bonds she receives from an oversubscribed bond offering to her clients in a way that is not strictly proportional to their purchase requests. So if it's oversubscribed, obviously everybody will not receive their entire quantity, but you should have a pro rata allocation corresponding to how much everybody ordered. So that would generally be the case, but in this question, just please note that the question clearly specifies there is a minimum lot size restriction. So you cannot put one share in somebody's account. Minimum, you can buy in groups of 1000 shares or 100 shares. If such is the case, somebody who applied for only one lot or who applied for only 1,000 shares may not get a allocation, because if it's oversubscribed, then he will or he should logically get less than 1,000 shares, but less than 1,000 shares is not an option. So in such a case, he may not be given and other clients may have to be given because of this lot size restriction. However, she cannot be preferentially doing the allocations, or if she's doing, or if she's allocating them in a random manner which does not treat the clients favorably or systematically disadvantages some clients at the benefit of the others. That is, she first puts it in the institutional accounts and then puts it in the individual accounts, and all that would be a violation of the course. If it is because of a technical factor that pro rata is not being maintained, then it is not a violation. So standard 3C deals with suitability. When members and candidates are in an advisory relationship with the client or prospect, they must make reasonable inquiry into a client's or prospective client's investment experience, risk and return objectives, and financial constraints prior to making any investment recommendations or taking any investment action, and reassess that information and update it regularly. Determine that an investment is suitable to the client's financial situation and consistent with the client's written objectives, mandates, and constraints before making a recommendation or taking investment action. Judge the suitability of investments in the context of a client's total portfolio. So it should be according to the mandate, it should be suitable, and you should carefully analyze investments before you put them in a client's account. You must judge the suitability of the investment for the client. It is also your ethical responsibility. When members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style, they must make only investment recommendations or take actions that are consistent with the stated objectives and constraints of the portfolio. In an advisory relationship, be sure to gather client information at the beginning in the form of an IPS. Consider client's needs and circumstances and their risk tolerance. Consider whether or not leverage is suitable for that client. If a member is responsible for managing fund to an index or other stated mandate, be sure that investments are consistent with the stated mandate. Members should put the needs and circumstances of each client into a written IPS. Consider the type of client and whether there are separate beneficiaries, investor constraints, any liquidity needs, or performance measurement benchmarks, and invest accordingly. Review the investor's objectives and constraints periodically to reflect any changes in the client's circumstances. You'll study it in more detail when you study portfolio management at level 3. Jessica Walters, an investment advisor, suggests to Brian Crosby, a risk-averse client, that covered call options be used in his equity portfolio. The purpose would be to enhance Crosby's income and partially offset any untimely depreciation in value should the stock or other circumstance affect its holdings unfavorably. Walters educates Crosby about all possible outcomes, including the risk of incurring an added tax liability if a stock rises in price and is called away. Conversely, the risk of his holdings losing protection on the downside if prices drop sharply. So please note, the covered call strategy per se you don't need to know for this question. As we can see that Jessica has made a reasonable effort into understanding why she needs this investment, and she has clearly explained it to the investor itself, the potential upsides and downsides of this trade, which will be there for any trade. There will be upsides and there will be downsides. So she is checking the suitability and then including, hence it is not a violation. A member gives a client account a significant allocation to non-dividend paying high-risk securities, even though the client has low risk tolerance and modest return objectives. Violation of the standard of suitability. The investment was not suitable. A member puts a security into a fund she manages that does not fit the mandate and is not a permitted investment according to the disclosures. Again, a violation. A member starts his own money management business but puts all clients in his friend's hedge funds. Clearly a violation. So you started, you accepted the money. Once they gave you the money, you didn't do any management. You put it in your friend's hedge funds. Standard 3D in duties to clients deals with performance presentation. When communicating investment performance information, members and candidates must make reasonable efforts to ensure it is fair, accurate, and complete. Members must avoid misstating performance or misleading clients and prospects about investment performance of themselves or their firms. Should not misrepresent past performance or reasonably expected performance, and should not state or imply the ability to achieve a rate of return similar to that achieved in the past. For brief presentations, member must make detailed information available on request and indicate that the presentation has offered limited information. Encourage firms to adhere to the global investment performance standards. Consider the sophistication of the audience to whom a performance presentation is addressed. Presenting performance of weighted composite of similar portfolios rather than a single account. So again, a composite is a collection of all portfolios managed in a similar type. So if you have a mid-cap composite, that is a collection of all mid-cap portfolios, then rather than cherry picking and presenting one mid-cap portfolio that has done well, it is always much better to present the performance of the entire composite. That is, you cannot exclude any fund. You must include all mid-cap portfolios. Including terminated accounts as part of the historical performance and clearly stating when they were terminated. Including all appropriate disclosures to fully explain the results. Maintain data and records used to calculate the performance being presented. Kyle Taylor of Taylor Trust, noting the performance of Taylor's Common Trust Fund for the past 2 years, states in the brochure sent to his potential clients that you can expect steady 25% CAGR over the year. Taylor's Trust Common Trust did increase at the rate of 25% per annum for the past year, which mirrored the increase of the entire market. The fund, however, never averaged that growth for more than 1 year, and the average rate of growth for all its accounts for 5 years was 5% per annum. So again, this is a violation of the performance presentation standard, because you cannot imply or you cannot guarantee or you cannot state that you will give 25% return, because you know, first of all, it is unreasonable. In the long run, the markets don't give that kind of a CAGR, and secondly, you yourself have had that performance only once in the last many years. Aaron McCoy is Vice President and Managing Partner of the Equity Investment Group of Mastermind Financial Advisors, a new business. Mastermind recruited McCoy because he had a proven 6-year track record with GNP Financial. In developing the advertising and marketing campaign, McCoy prepared an advertisement that included the equity investment performance he achieved at GNP Financial. The advertisement for Mastermind did not identify the equity performance as being earned while at GNP. Advertisement was distributed to existing clients and prospective clients of Mastermind. Again, a violation. Should have been disclosed that this performance was not earned recently, or this wasn't earned at this firm, it was at the past firm where McCoy was working. A member puts simulated results of an investment strategy in a sales brochure without disclosing that the results are not actual performance numbers. So in hindsight, you can always compute many strategies that would have worked well. So those simulated results cannot be disclosed or cannot be shown in the presentations, and definitely should be disclosed. In materials for prospective clients, a member uses performance figures for a large cap growth composite. So it's a set of large cap growth portfolios that she has created by choosing accounts that have done relatively well and including some accounts with significant mid cap exposure. Another example of a violation of the presentation standard. Members and candidates must keep information about current, former and prospective clients confidential unless the information concerns illegal activities, disclosure is required by law, or the client or prospective clients permits the disclosure of the information. You should keep everything confidential. If illegal activities by client are involved, members may have an obligation to report to the authorities. Confidentiality standard extends to former clients as well. The requirements are not intended to prevent members from cooperating with the CFA Institute Professional Conduct Program investigation. So if a PCP investigation, then again you may be required to disclose. Members should avoid disclosing information received from a client except to authorized co-workers who are also working for the client. Members should follow firm procedures for storage of electronic data and recommend adoption of such procedures if they are not in place, so that data cannot be easily stolen or cannot be disclosed. Sarah Connor, a financial analyst employed by Johnson Investment Counselors, provides investment advice to the trustees of City Medical Center. The trustees have given her a number of internal reports concerning City Medical's needs for physical plant renovation and expansion. They have asked Connor to recommend investments that would generate capital appreciation endowment funds to meet projected capital expenditures. Connor is approached by a local businessman, Thomas Casey, who is considering a substantial contribution either to City Medical Center or to another local hospital. Casey wants to find out if the building plans of both institutions before making a decision, but he does not want to speak to the trustees. So Connor is managing the fund for a company. That company needs investments, it needs donations. There is a donor also who has for some reason approached Connor and wants to know the building plans of the company. Now Connor knows that that company that she's working for, she's employed as a fund manager, needs the donation. So should she disclose the building plans of the City Medical Center to this new party who claims he wants to give a donation? No, even if he wants to give a donation or even if he thinks that it's going to benefit the client, she still cannot divulge any confidential information unless it has been permitted. So she can go and seek permission that there is somebody who's interested in giving a donation. Am I allowed to show your plans, or can you show him the plans? But she at the moment cannot disclose anything to the individual. David Bradford manages money for a family-owned real estate development corporation. He also manages the individual portfolios of several of the family members and officers of the corporation, including the chief financial officer. Based on the financial records from the corporation as well as some questionable practices of the CFO, Bradford believes that the CFO is embezzling money from the corporation and putting it into his personal investment account. What should David Bradford do? So he's working for a company, he's working as a fund manager, and he feels another employee is embezzling money. Now once again, the standards don't require you to report to the police or to report to the authorities. But in this case, it is his responsibility that he should inform the the compliance officer or his supervisor or somebody in the family or whoever who thinks would be able to dig deeper into the issue and find out if there is anything amiss. So this question just explains that even though in this case there is confidential information based on which he has derived this conclusion. So there were these reports and data that would be presented to David Bradford that would be very confidential, that he is not expected to share with anyone else. But in the case of a violation or a violation of law, members may be required to disclose the confidential information in order to benefit the client or for the best interests of the profession. A member has learned from his client that one of his goals is to give more of his portfolio income to charity. The member tells this to a friend who is on the board of a charity and suggests that he should contact the client about a donation. Violation of the standard of confidentiality. A member learns that a pension account client is violating the law with respect to charges to the pension fund. So again, if it is confidential information but it is illegal or the information is violating the law, then disclosure may be required. So if the law requires that any person who finds out of any wrongdoing or who sees any such should come and report, then he may be required to disclose that confidential information. He cannot say that information was confidential, so even though it was wrong, I did nothing about it. Disclosure may be needed in the case of violations of law especially. Standard 4 relates to duties to employers. So Standard 4A talks about loyalty. In matters related to their employment, members and candidates must act for the benefit of their employer and not deprive their employer of the advantage of their skills and abilities. They should not divulge confidential information or otherwise cause harm to their employer. So if you're dissatisfied with your salary and hence you've decided that you will not work more than 2 hours in the day, then that is an ethical violation. Members must not engage in any activities which would injure the firm, deprive it of profit, or deprive it of the advantage of the employee's skills and abilities. Members should always place client interests above the interests of their employer, but consider the effects of their actions on firm integrity and sustainability. So even if there's a conflict, standards don't necessarily require you to report to the legal authorities. You should first go to the compliance officer, try to see what was it, try to get it corrected, and then report to higher authorities if needed. There is no requirement that the employee put employer interests ahead of family and other personal obligations. So if your child has met with an accident, the standard doesn't say that you have to work 9 to 5 before you can go and tend to his needs. However, it is expected that employers and employees will discuss such matters, that in case of emergencies you can leave early, etc., and balance these obligations, that is your personal obligations, with the work obligations. For the employer, members are encouraged to give their employer a copy of the core and standards. Employers should not have incentive and compensation systems that encourage unethical behavior. Independent practice for compensation is allowed if a notification is provided to the employer fully describing all aspects of the services, including compensation, duration, and nature of the activities, and if the employer consents to all terms of the proposed independent practice before it begins. Members must continue to act in their employer's best interests until resignation is effective. Activities which may constitute a violation include misappropriation of trade secrets, misuse of confidential information, soliciting employers' clients prior to leaving. After leaving, you may solicit. In a new firm, you may solicit, but not by using the lists or by contact details taken from this employer. If you generally remember them from memory and you have a relationship with the client, then you may approach them after you have left. But any confidential data, any client lists, etc., you cannot take with you and use those lists to contact all previous clients. Self-dealing, trading on your own, misappropriating client assets are all examples of violations of the standard. Employer records on any medium, that is home computer, PDA, cell phone, are the property of the firm. So even contacts on your own cell phone that were acquired when you were in the previous employer cannot be used to contact people again. You have to build your contacts again, take their contacts again, and then start contacting people. Once an employee has left a firm, simple knowledge of names and existence of a former client is not confidential. Also, there is no prohibition on the use of experience or knowledge gained with a former employer. There may be isolated cases where a duty to one's employer may be violated in order to protect clients or the integrity of the market and not for personal gain. So whistleblowing is a common example. If your employer is doing some malpractices or is not working in the right way, and despite your efforts nothing is being done to correct it, then you may need to inform the authorities or the relevant people. The applicability of the standard is based on the nature of employment, employee versus independent contractor. If members and candidates are independent contractors, they still have the duty to abide by the terms of the agreement. So even as an independent contractor, you should follow all these ethical responsibilities that we have just presented. Dennis Elliott has hired Sam Chisholm, who previously worked for a competing firm. Chisholm left his former firm after 18 years of employment. When Chisholm begins working for Elliott, he wants to contact his former clients because he knows them well and is certain that many will follow him to his new employer. Is Chisholm in violation of standard 4A if he contacts his former clients? Just contacting the clients is not a violation. Contacting from your own memory or from your own relationships or from your own means is allowed. But using any client lists or using any contacts developed at that firm or any stored records when you were working at the other firm would be a violation of the standard. Several employees are planning to depart their current employer within a few weeks and have been careful not to engage in any activities that would conflict with their duty to their current employer. They have just learned that one of the employer's clients has undertaken a request for proposal to review and possibly hire a new investment consultant. The RFP has been sent to the employer and all of its competitors. The group believes that the new entity to be formed would be qualified to respond to the RFP and eligible for the business. The RFP submission period is likely to conclude before the employee's resignations are effective. Is it permissible for the group to respond to their RFP under their anticipated new firm? No, because knowledge and skills gained are allowed to be used. But if you will not be in employment or you will not be in outside the company, that is, you'll still be working for this company, then you cannot apply for the RFP. A member solicits clients and prospects of his current employer to open accounts at the new firm he will be joining. He hasn't yet joined. He will be joining shortly. Clearly a violation. Two employees discuss joining with others in an employee-led buyout of their employer's emerging markets investment management business. So as long as you're discussing at lunchtime and you're not discussing at the time you're supposed to be working for the client, it is fine. So if you're working on your own time, if you're discussing on your own time and you want to join an employee-led buyout of the firm, it's fine. It's not an ethical violation. A member is writing a research report on a company as a contract worker for employer A using A's premises and materials with the understanding that employer A does not claim exclusive rights to the outcome of her research. As she is finishing the report, she is offered a full-time job by employer B and sends employer B a copy of a draft of her report for publication. This will be a violation because your employer may not claim exclusive rights, but he definitely has the right to receive that report first, and then you can disseminate to whoever you like in accordance with the terms of the agreement that you have with the employer. If before completing the report or before giving it to your employer, you give it to outside parties, then that will be a violation of the ethical standards. A member helps develop software for a firm while acting as an unpaid intern and takes the software without permission when she takes a full-time job at another firm. Another example of the violation. Doesn't matter whether you are paid or unpaid. A member prepares to leave his employer and open his own firm by registering with the SEC, renting an office and buying office equipment. Again, as long as he is doing it on his own time. That is, he is not interfering, or it is not interfering with his responsibilities at the firm. This will not be a violation. A member is a full-time employee and wants to accept a paid position as town mayor without asking his employer's permission. A violation. So if it's a paid position, you have to disclose how much time will you be devoting to that job. It may not be a conflict directly with your employer's work, but it will demand your time and energy, and hence your employer may not be comfortable with that. A member who has left one employer using public sources to get the phone number of previous clients and solicits their business for her new employer. So he has left the employer and now is using public sources. No, how else will he get the numbers? He has to use some source. So if he's using public sources to get the numbers and then contacting, knowledge of the client's existence is not a violation. You cannot use lists from your previous employer. So this is not a violation. Standard 4B, very importantly, deals with additional compensation arrangements. So please understand, members and candidates must not accept gifts, compensation or consideration that competes with or might reasonably be expected to create a conflict of interest with their employer's interest unless they obtain written consent from all parties involved. Compensation includes direct and indirect compensation from a client and other benefits received from third parties. Written consent from a member's employer includes email communication. Make an immediate report to the employer detailing any proposed compensation and services, if additional to that provided by the employers. Details include any performance incentives should be verified by the offering party. Jeff Whitman, a portfolio analyst for Adams Trust Company, manages the account of Carol Cochran, a client. Whitman is paid a salary by his employer, and Cochran pays the trust company a standard fee based on the market value of the assets in her portfolio. Cochran proposes to Whitman that any year that my portfolio achieves at least 15% before taxes, you and your wife can fly to Monaco at my expense and use my condominium during the third week of January. Whitman does not inform his employer of the arrangement and vacations in Monaco the following January as Cochran's guest. Violation. Additional compensation agreements must be disclosed and written consent taken from the employer and from all parties involved. This may not be a conflict of interest, but it is an additional compensation agreement. If he has methods to benefit her client personally, then it may be a conflict of interest also, or to the detriment of other clients. A member is on the board of directors of a company whose shares he purchases for client accounts. As a member of the board, he receives the company's product at no charge. This is again an additional compensation agreement must be disclosed to the employer because it can create a potential conflict of interest. So you are on the board of directors. So you're a fund manager, you invest in this company. Because you're invested, this company has also put you on the board. So when you're serving on this board, you're receiving the product free of charge. So just as a board member, there is no conflict of interest because you are a shareholder. So you will work in the best interest of yourself and the rest of the shareholders. But when you start receiving this free of cost compensation, then there is a conflict of interest. Now you may not be representing the best interests of your firm and the shareholders because you are influenced by the management. So this additional compensation agreement must be disclosed to the employer. Standard 4C is about responsibilities of supervisors. So members and candidates must not accept gifts, compensation or consideration that competes with or might reasonably be expected to create a conflict of interest with their employer's interest unless they obtain written consent from members and candidates. So standard 4C talks about the responsibilities of supervisors. So members and candidates must make reasonable efforts to detect and prevent violations of applicable laws, rules, regulations, and the code and standards by anyone subject to their supervision or authority. So they must make steps to prevent employees from violating laws, rules, regulations, or the code and standards, as well as make reasonable efforts to detect violations. Members with supervisory responsibility should enforce firm policies regarding investment or non-investment behavior, example, mandatory vacations, etc. So they must be taken. Understand that an adequate compliance system must meet industry standards, regulatory requirements, and the requirements of the code and standards. Members with supervisory responsibilities have an obligation to bring an inadequate compliance system to the attention of the firm's management and recommend corrective action. While investigating a possible breach of compliance procedures, it is appropriate to limit the suspected employee's activities. A member or candidate faced with no compliance procedures or with procedures he believes are inadequate must decline supervisory responsibility in writing until adequate procedures are adopted by the firm. So as a supervisor, it is in some ways your responsibility to ensure that your firm has good compliance and good procedures and good reporting requirements such that the standards and the laws are adhered to. If not, you must express your disapproval and dissent, and you may need to step down also. Members should recommend that as employer adopt a code of ethics. Employees should not commingle compliance procedure with the firm's code of ethics. This can dilute the goal of reinforcing one's ethical obligations. Members should encourage employers to provide their code of ethics to clients. Adequate compliance procedures should be clearly written, be easy to understand. So what is ethical or what is good behavior should be separate from what is required. So compliance is by law and by mandate, and the code of ethics is how you should behave and how you should treat clients and other participants. So a compliance procedure should be clearly written and easy to understand. Designate a compliance officer with authority. Have a system of checks and balances. Outline the scope of procedures. Outline what is conducted or what is permitted. Contain procedures for reporting violations and sanctions by other employees and by individuals. Once the compliant program is instituted, the supervisor should distribute it to the proper personnel, update it, continually educate staff regarding the procedures, issue reminders, require professional conduct evaluations, review employee actions to monitor compliance and identify violations. Enforce procedures once a violation occurs. If there is a violation, respond promptly and conduct a thorough investigation while placing limitations on the wrongdoer's activities. Jane Mattock, Senior Vice President and Head of the Research Department of HNV, a regional brokerage firm, has decided to change her recommendation for timber products from buy to sell. In line with HSV's procedures, she orally advises certain other HNV executives of her proposed actions before the report is prepared for publication. As a result of his conversation with Mattock, Dieter Frampton, one of the executives of HNV accountable to Mattock, immediately sells stock from his own account and from certain discretionary client accounts. In addition, other personnel informs certain institutional customers of the changed recommendation before it is printed and disseminated to all customers who have received previous timber reports. So, of course, it is a violation of the duties to clients and many ethical violations done by Dieter as well as the other employees who informed institutional clients before the information was disseminated to everybody. However, Mattock in this case is also at violation. She did not do anything wrong per se, but she failed to effectively supervise. She was in a supervisory position and she should have ensured that not everybody can find out about what she is thinking and any changed recommendations so easily and disseminated without her coming to know. So she should have instituted checks and balances to ensure, at least to some degree, that this does not happen. A member responsible for compliance by the firm's trading desk notices a high level of trading activity in a stock that is not on the firm's recommended list. Most of this trading is done by a trainee and the member does not investigate this trading. Again, he is failing on his supervisory responsibilities. He must investigate and see as to what these trades are and why they are being done. Standard 5 deals with investment analysis, recommendations and actions. So 5A talks about diligence and reasonable basis. So members and clients must exercise diligence, independence and thoroughness in analyzing investments, making investment recommendations and taking investment actions. Have a reasonable and adequate basis supported by research and investigation for any analysis, recommendations and actions. So the application here will depend on the investment philosophy adhered to, the candidate's role in the decision-making process, whether he's a fund manager or an analyst, and the resources and support provided to him by the employers. These factors dictate the degree of diligence, thoroughness, and the proper level of investigation that the employee can put in. So how we define reasonable basis is the level of research that is required to satisfy the requirement for due diligence, and this will differ depending on the product or service offered. A list of some things that should be considered prior to making a recommendation or taking investment action includes analysis of the financial results, operating history, business cycle stage, fees and historical returns or historical results for a mutual fund must be checked. Limitations of any quantitative models used should also be assessed before you are trading based on some technical analysis or some quantitative analysis based strategy. A determination of whether peer group comparisons for valuation are appropriate or not. If you're using a third party research or some secondary research, then again you must evaluate the quality of that service provider from time to time. So members should encourage their firms to adopt a policy for periodic review of the quality of third-party research if they have not. Examples: you should check the assumptions that the third-party analysts are using, determine how rigorous the analysis was, identify how timely the research is, evaluate objectivity and independence of the recommendations. For quantitative research, members must be able to explain the basic nature of the quantitative research and how it is used to make investment decisions. Members should consider scenarios outside those typically used to assess downside risk and the time horizon of the data used for the model to ensure that both positive and negative cycles have been considered. So a lot of technical analysis based trend following strategies, etc. You must be doubly sure as to the maths is correct or not and what is the basis. So don't just use data from good times. see a bad down cycle also, a good cycle also, and then try to come to your conclusions. If you're using external advisors, then you should make sure that the firms have procedures in place to review any external advisors, or they should ensure that the advisors have adequate compliance and internal controls, present returns information that is correct, do not deviate it from their stated strategies. Group research and decision making. Even if a member, very importantly, even if a member does not agree with the independent and objective view of the group, let's say the decision has been taken in a committee, he does not necessarily have to decline to be identified with the report. So you can say that the report was made in consideration of this group comprising of these people. Let's say one person did not agree with the report. Then it is not necessary that his name be removed, as long as he feels that there was a reasonable and adequate basis and his point of view was heard, may have been rejected. So as long as he was given an opportunity and he feels the committee did follow the right process, he does not have to be disassociated. If he feels that the recommendations are out of whack and he does not want to be associated and he wants to express his discontent and dissent with the report, then he may choose to. However, it will not be an ethical violation even if your view was not accepted or it was something completely contradictory also to your view, as long as a reasonable basis and a group, a process was followed. So members should encourage their firms to have a policy requiring that research reports and recommendations have a basis that can be substantiated as reasonable and adequate. Have detailed written guidance for proper research and due diligence. Have measurable criteria for judging the quality of research and base analyst compensation on criteria, that is the quality of research rather than the stock price performance or rather than the business, etc. Have written procedures to provide a minimum acceptable level of scenario testing for computer-based models and include standards for the range of scenarios, model accuracy over time, and a measure of the sensitivity of cash flows to model assumptions and inputs. So provide some scenario analysis and see what, in case your assumptions go wrong, what will be the output of the model, what will be the profit or the loss. All that should also be presented and should also be looked at. Have a policy for evaluating outside providers and establish how often these evaluations should be repeated. Adopt a set of standards that provides a criteria for evaluating external advisors and state how often the review of external advisors will be performed. Helen Hawk manages the corporate finance department of Sarkozy Securities. The firm is anticipating that the government will soon close a tax loophole that currently allows oil and gas exploration companies to pass on drilling expenses to holders of a certain class of shares. Because market demand for this tax advantaged class is currently high, Sarkozy convinces several companies to undertake new equity financing at once before the loophole closes. Time is of the essence, but Sarkozy lacks resources to conduct adequate research on all issuing companies. Hawk decides to estimate the IPO prices based on relative size of each company and to justify the pricing later when her staff has time. So there is a tax advantaged class of securities, high demand by investors and easy for corporations to sell. A new regulation has come that will close this tax loophole. Before the tax loophole gets closed, all fund managers and all institutions want to issue this security. So now everybody wants to issue this security, so there's a lot of demand. However, to conduct an IPO or to issue securities, the pricing has to be determined, and the pricing can only be determined after a thorough analysis of the prospects of the company and the valuation process. However, Helen Hawk and Sarkozy don't have that kind of resource. So what they do is they use the same valuation multiple probably and value each company according to their size. and they do the issues or go ahead with the issues. This is a violation of diligence and reasonable basis, because to arrive at these prices, Sarkozy does not and Helen do not have a reasonable basis. So Helen should only accept the work that she can do, probably take on one or two of the bigger IPOs and let other funds or let other investment banks do the other IPOs, so that there is diligence and reasonable basis in the prices that she is determining and the IPOs that she is doing. This will be a violation of the standard of diligence and reasonable basis. A member in the corporate finance department prices IPO shares without doing adequate research because she wants to get them to market quickly. Once again, an example of lack of diligence and reasonable basis. A member writes a report in which she estimates mortgage rates. After reviewing it, a majority of the investment committee vote to change the report to reflect a different interest rate forecast. Must the member dissociate herself from the report? Not necessarily. If he feels the proper process was followed and the committee did look at all aspects and then had her conclusions or had their conclusions, then she need not dissociate from the report. However, if she feels that the committee just rejected without even thinking, without even analyzing her assumptions and her logic, then she can or she must dissociate from the report. So per se, dissociation is not required as long as the due process was followed in group research. Even if the end result is different from what you are expecting or what your view is. A member is a principal in a small investment firm that bases its securities recommendations on third-party research that it purchases. Now this per se will not be a violation. However, the member must put in place procedures that validate the assumptions that the third-party research is using and from time to time evaluate the quality of this third-party research. A member selects an outside advisor based solely on the fact that the selected firm has the lowest fees for managing international equities accounts. Again, this is not diligence and reasonable basis. Lowest fees is a good thing. However, he should have a reasonable servicing capability and performance capabilities as well. A member investigates the management fees track record and investment strategy of a hedge fund and recommends it to a client. The member accurately discloses the risks involved with hedge funds soon after the fund reports terrible losses and suspends operations. No violation. She did her job. Investments do have risks. The risks have to be explained, but she cannot control the outcome of the investment. There is no violation. Standard 5B deals with communication with clients and prospective clients. So members and candidates must disclose to clients and prospective clients the basic format and general principles of investment processes used to analyze and select securities and construct portfolios, and must promptly disclose any changes that might materially affect those processes. Use reasonable judgment in identifying relevant factors that are important to their analysis, recommendations or actions, and include those factors in communication with the clients and prospective clients. So the whole model you don't have to present, but at least the basic assumptions always must be included when you're communicating with your clients, and disclose the basic format and the general principles. Distinguish between fact and opinion in the presentation of investment analysis and recommendations. Do not pass off an opinion as a fact. Proper communications is critical to provide quality services. Members must distinguish between opinions and fact and always include the basic characteristics of the security being analyzed in a research report. Members must illustrate to clients the prospects of the investment members must illustrate to clients and prospects the investment decision making process that has been utilized. All means of communication are included, not just research reports. In preparing recommendations for structured securities, allocation strategies, or any other non-traditional investments, members should communicate those risk factors that are specific to those investments. That is, in more complicated strategies, a more elaborate risk disclosure may be needed. In all cases, members should communicate the potential gains and losses on the investment clearly in terms of total returns. When using projections from quantitative models and analysis, members may violate the standard by not explaining the limitations of the quantitative model. That is, history is not a representation of the future, or the model has limitations because at the end of the day it is just a fitting model, or it is the best fit model. It is not a precise explanation of past events or future events. So these limitations provide a context for judging the uncertainty regarding the estimated investment result. Selection of relevant factors will be a judgment call, so be sure to maintain records indicating the nature of research and be able to supply additional information if it is requested by the client or other users of the report. So you must have a strong basis that you must keep in record with yourself, so that if any client wants a more detailed analysis of why we are recommending, we should be able to provide him with that analysis. May & Associates is an aggressive growth manager that has represented itself since its inception as a specialist at investing in small cap domestic stocks. One of May's selection criteria is a maximum capitalization of $250 million. After a string of successful years, May expanded its client base significantly to the point where AUM now is $3 billion. From 250 it has now become, my apologies, the AUM now is over 3 million. This is the maximum capitalization criteria. That is, it was a mid cap to small cap investor. That companies above $250 million in market cap, this company did not invest in. So whoever was investing with this fund knew that it's taking exposure to small cap stocks. However, the fund has now become very big. For liquidity purposes, May's chief investment officer decides to lift the maximum permissible market cap ceiling to 500 and change the firm's sales and marketing literature accordingly to inform prospective clients and third-party consultants. So this will be a violation because May & Associates is only informing prospective clients and third-party consultants. It should also inform its current clients and give them sufficient time so that they can withdraw their investments if need be and invest with other fund managers who are providing them the desired exposure. Rather than lifting the ceiling for its universe from 250 to 500, May extends its small cap universe to include a number of non-US companies. So that also could have been done. Again, in this case, it will have to inform all clients and prospective clients and third-party consultants who are affected. So it's not raising the ceiling, but it's 250 million now has been extended from US to non-US companies also. A member sends a report to his investment management firm's clients describing a strategy his firm offers in terms of the high returns it will generate in the event interest rate volatility decreases. The report does not provide details of the strategy because they are deemed proprietary. The report does not consider the possible returns if interest rate volatility actually increases. This will be a violation because you are not required to present the details, but at least the basic assumptions and basic scenario analysis should be presented. So you're saying that it will give good returns if volatility decreases. But what happens if volatility increases? You're not disclosing the strategy. You're just giving a scenario. If volatility increases, this model will show so much return. That should have been presented. Or some basic construct must be presented even though entire details need not be divulged. You can go through example 6, 7, 8. There are again examples of changes happening which should be communicated to clients. A member changes his firm's outside manager of real estate investments and provides information of this change only in the firm's annual report where outside advisors are listed. So again, this is a big change. It's not a minor administrative, it's not the secretary leaving and joining some other company that doesn't have to be informed. It is your own fund manager. He's a key person. Probably many people in the firm invested because of this person. So if he is leaving and joining another company, then clients should be immediately informed. Standard 5C deals with record retention. So members and candidates must develop and maintain appropriate records to support their investment analysis, recommendations, actions, and all other investment related communications with clients and prospective clients. Members must maintain records that support the reasons for the conclusion and any investment actions taken. Such records are the property of the firm. If no regulatory standards are in place, CFA Institute recommends at least a 7-year holding period. A member who changes the firm must recreate the analysis documentation supporting her recommendation using publicly available information or information obtained from the company, that is a new company, and must not rely on memory or materials created at her previous firm. So now you cannot even rely on memory. So if you've joined a new company, you left one sell-side firm and joined another sell-side firm, then you have to initiate on all stocks again sourcing the information once again from public sources or from the whatever is in possession of that new company to recreate your reports. You are not allowed to use anything from your previous employer or any information that was in your memory but the source was from the previous employer. So you need to source it again yourself and then use those facts. The record keeping requirement generally is the firm's responsibility. One of Nicholas Lindstrom's clients is upset by the negative investment returns in his equity portfolio. The policy statement for the client requires that the manager follow a benchmark-oriented approach. The benchmark included a 35 investment allocation in the technology sector. Because technology was so big, the benchmark had 35% technology. Over the past 3 years, that portion suffered severe losses, and now the client complains that why did you allocate so much money to this sector? If you had proper records, you could show the client that the mandate was to follow this benchmark. This benchmark has 35% in technology and hence there was a 35% allocation to technology. A member bases his research reports on interviews, his own analysis, and industry reports from third parties on his industry and related industries. That's what he's supposed to do. So there is no violation. He is not accessing any of his previous employers' records. He's sourcing the information again and preparing the report. When a member leaves a firm at which he has developed a complex model, he takes documentation of the model assumptions and how they were derived, since he will use the model at his new firm. This is what we mean that you cannot do. You cannot take anything from your previous employer. Standard 6 tells us how to handle conflicts of interest. So 6A would first tell us about the disclosure of conflicts. Members and candidates must make full and fair disclosure of all matters that could reasonably be expected to impair their independence or objectivity or interfere with their duties to their employer, clients, and prospective clients. Members and candidates must ensure that such disclosures are prominent, are in plain language, and communicate the relevant information effectively. So there can be many situations of a conflict of interest. If your wife works in the same company as you are working, then often you may be in appraisals and in other recommendations, you may want to favor her as compared to others, or that risk is there. if your brother or your relative works in a company or works in a sell side firm, then you may give him more business or you may deal with him more. So all these situations where a potential conflict can be there, you must disclose to your employer. Members must fully disclose to clients, prospects, and their employers all actual and potential conflicts of interest in order to protect investors and employers. These disclosures must be clearly stated. The requirement that all potential areas of conflict be disclosed allows clients and prospects to judge the motives and potential biases for themselves. Disclosure of broker-dealer market-making activities would be included here. Board service is another area of potential conflict. So if you're also on the board of a company, then you may be investing or you may be showing a favorable or diverting more of your funds as a fund manager to that company. So again, it's not a problem. Being on the board is not an issue. It's just that you should disclose to your clients that I'm also on the board of this company so that they can judge for themselves. The most common conflict is which requires is actual ownership of stock in companies that the member recommends or the clients hold. So if I've also invested and my fund is also invested, then definitely that needs to be disclosed, because the clear conflict is that I would want to sell it or I would want to buy more so as to help my personal portfolio as well. Another common source is interest in a member's compensation or bonus structure, which can potentially create incentives to take actions that produce immediate gains for the member with little or no concern for long-term returns for the client. Such conflicts must be disclosed when the member is acting in an advisory capacity and must be updated in the case of significant change in the compensation structure. So if it's a quarterly bonus or a semi-annual or an annual bonus that the fund manager gets based on how much returns he makes in that year, without regard to 3-year or 5-year performance, then again this will incline the manager to take more short-term focused strategies which may not be in the best long-term interests of the client. So such situations must also be disclosed to the client. Members must give the employer enough information to judge the impact of the conflict, take reasonable steps to avoid conflicts, and report them promptly if they occur. Any special compensation arrangements, bonus programs, commissions, and incentives should be disclosed. Hunter Weiss is a research analyst with Farmington Company, a broker and investment banking firm. Farmington's merger and acquisition department has represented Wimco, a conglomerate, in all of its acquisitions for 20 years. From time to time, Farmington officers sit on the boards of directors of various Wimco subsidiaries. Weiss is writing a research report on Wimco. So clearly, Farmington and Wimco have a strong relationship. He may be biased towards writing a favorable report towards Farmington. So this strong investment banking relationship and Farmington's employees serving in boards of Wimco is a conflict of interest that the clients of Farmington must be aware of. So to Farmington's clients, you must disclose that we are writing a report, it's a favorable report, but we have all these relationships, so you can judge any potential conflict for yourself. Samantha Sneed, a portfolio manager for Thomas Investment Counsel, specializes in managing defined benefit pension plan accounts, all of which are in accumulative phase and have long-term investment objectives. A year ago, Sneed's employer, in an attempt to motivate and retain key investment professionals, introduced a bonus system that rewards managers on the basis of quarterly performance. Sneed changes her investment strategy and purchases several high beta stocks. These purchases are seemingly contrary to the IPS. Now an officer of Griffin Corporation, one of the clients asks why Griffin Corporation seems to be dominated by high beta stocks that often appear amongst the most actively traded issues. No change in the objective or strategy has been recommended by Snead during the year. So this is what may happen if you have structures which encourage short-term performance. So it's first of all, it's a disclosure of the conflict of interest. That is, Snead should have informed the clients that we are rewarded by short-term gains, or our bonus is based on quarterly performance, even though your requirement or even though your IPS is more long-term focused. So definitely suitability is also in question here. The standard on suitability is also violated, and also the standard of disclosing of the conflict that we are rewarded by short-term performance. An investment management partnership sells a significant stake to a firm that is publicly traded. So a big company acquires this firm. The partnership has added the firm's stock to its recommended list and approved its commercial paper for cash management accounts. Again, a conflict that must be disclosed, because if he is your employer, you will most likely issue a favorable rating for him. So the clients must be advised that we have now been acquired by this public company. Hence, either we should not have a rating on that stock, that is, put it on the restricted list, or at least disclose the conflict. A member provides clients with research about a company and his wife inherits a significant amount of stock in the company. Again, he can personally also benefit, so he must disclose this conflict. Similarly, please go through examples 7, 8 and 9. Again, examples of situations where conflicts must be disclosed to the clients and employers. Standard 6B deals with priority of transactions. So investment transactions for clients and employers must have priority over investment transactions in which a member or a candidate is a beneficial owner. The pecking order is first clients, second employer, and third the employee. Client transactions take priority over personal transactions and over transactions made on behalf of the member's firm. Personal transactions include situations where the member is a beneficial owner. Personal transactions may be undertaken only after clients and employer have an adequate opportunity to act. Note that family member accounts that are client accounts should be treated just like any client account. They should not be disadvantaged. So if your family member is a client, then you can't say that he's my family member, so he will be given the lowest priority. No, now he is a regular client, so you have to treat him fairly. Information about pending trades should not be acted on for personal gain. The overriding considerations with respect to personal trades are that they should not disadvantage any client. All firms should have in place basic procedures that address conflicts created by personal investing. So limited partnerships or limited participation in equity IPOs. Members can avoid these conflicts by not participating in IPOs. Restrictions on private placements. Strict limits should be placed on employee acquisition of these securities, and proper supervisory procedures should be in place. Participation in these investments raises conflict of interest issues similar to IPOs. So if it's a reasonably priced IPO or a reasonably priced private placement, then if employees are allowed to invest, they will first invest on their own, and the clients will not get an opportunity to get the allocation they want. Whereas for other issues, the employees may not subscribe because they anyways know more, and the client may now get the allocation, but again the employees are benefiting at the expense of the client. Establish blackout or restricted periods. So employees involved in investment decision making should have blackout periods prior to trading for clients. That is, no front running should be allowed. That is the purchase or sale of securities in advance of an anticipated client or employer purchase. So before I give a recommendation, I may want to front run. That is, before I give a sell call to the whole world, I may want to sell my own shares. The size of the firm and the type of security should help dictate how severe the blackout requirement should be. Supervisors should establish reporting procedures including duplicate trade confirmations, disclosure of personal holdings, beneficial ownership positions, and pre-clearance procedures. When requested, members must fully disclose to their investors their personal trading policies. So members should encourage the firms to adopt such procedures if they have not. So every month you should disclose your portfolio. You should not be allowed to trade in stocks that your firm is actively trading in, so on and so forth. Erin Tamer, a portfolio manager at Esposito Investments, manages the retirement account established with the firm by her parents. Whenever IPOs become available, she first allocates shares to all her other clients for whom the investment is appropriate. Only then does she place any remaining portion in her parents' accounts if the issue is appropriate for them. She has adopted this procedure so that no one can accuse her of favoring her parents. This will be a violation because parents have to be treated like regular clients. They cannot be disadvantaged. A brokerage's insurance analyst, Denise Wilson, makes a closed-circuit report to her firm's branches around the country. During the broadcast, she includes negative comments about a major company within the industry. The following day, Wilson's report is printed and distributed to the sales force and public customers. The report recommends that both short-term traders and intermediate investors take profits by selling the company's stocks. Several minutes after the broadcast, Ellen Riley, the head of firm's trading department, closes out a long position. Shortly thereafter, Riley established a sizable put position in the stock. Riley claims she took this action to facilitate anticipated sales by institutional clients. Please note, clients must be given a reasonable opportunity to trade. Several minutes. Is it a reasonable opportunity for somebody to read the report and trade on it? So had he waited a few days, a week maybe, and then sold out, then you could assume that the clients have had a reasonable opportunity to trade on the report, and now even the firm or the employer himself can trade. But if he does it several minutes after the broadcast, then it would be a violation of the ethical standard. First the client, then the employer, and then you yourself. Again, 3, 4, 5 are clear violations of the transactions or the standard concerning priority of transactions. Please go through them. A member reveals a sell rating on some securities in a broadcast to all of her brokers. The changed rating is sent to clients the next day. So there's a delay first of all. Shortly after revealing the change to the brokers and prior to dissemination, she buys puts on the stock for her firm's account. Again, a violation. The clients, that is the brokers, should inform the clients, and the clients should be given the opportunity to trade first. Standard 6C relates to referral fees. So members and candidates must disclose to their employers, clients, and prospective clients as appropriate any compensation, consideration, or benefit received by or paid to others for recommendation of products and services. So this is referral fees. Members must inform employers, clients, any prospects of any benefit received for referrals of customers and clients, allowing them to evaluate the full cost of the service as well as any potential partiality. All types of considerations must be disclosed. So if you're recommending a particular mutual fund to a particular client and that mutual fund is paying you $10 for every new client, then that must be disclosed. Members should encourage their firms to adopt clear procedures regarding compensation for referrals. Firms that do not prohibit such fees should have clear procedures for approval, and members should provide their employers with updates at least quarterly regarding the nature and value of a referral compensation. So in duties to employers, we study that any additional compensation must be disclosed and approval taken from the employer in writing. So even with referral fees, it will be like an additional compensation. So if the employee is getting any additional fees for recommending some services, then even to his employer he must disclose, and to his clients also that must be disclosed. Brady Securities, a broker-dealer, has established a referral arrangement with Lewis Brothers, an investment counseling firm. Under this arrangement, Brady Securities refers all prospective tax-exempt accounts, including pension, profit sharing and endowment accounts, to Lewis Brothers. In return, Lewis Brothers makes available to Brady Securities on a regular basis the security recommendations and reports of its research staff, which registered representatives of Brady Securities use in serving customers. In addition, Lewis Brothers conducts monthly economic and market reviews for Brady Securities personnel and directs all stock commission business generated by referral account to Brady Securities. Willard White, a partner in Lewis Brothers, calculates that the incremental cost involved in functioning as the research department of Brady Securities amounts to about $20,000 annually. Referrals from Brady Securities last year resulted in fee income of $200,000, and directing all stock trades through Brady Securities resulted in additional costs to Lewis Brothers clients of $10,000. So what is happening is that Brady Securities is recommending Lewis Brothers. In return, Lewis Brothers provides him research. Now, whatever be the costs, so Lewis received a fee income of $200,000 because of the accounts that were referred by Brady Securities, and in cost they had to spend $20,000 annually for providing research to Brady Securities. Also, all trades done by Lewis Brothers are now done through the Brady Securities account. So definitely the clients who Brady Securities is advising need to know of this referral arrangement, because Lewis Brothers may not be the best investment management firm and Brady Securities may be recommending just because they are getting these fees and referral payments. So this arrangement of referral fees of one company referring the other and in turn getting brokerage or in turn getting research and additional benefits must be disclosed to all clients and potential clients so that people can judge the conflict of interest for themselves. Diane Branch, the CFO of Maxwell, contacts White and says that she is seeking an investment manager for Maxwell's profit sharing plan. She adds that my friend Harold Hill at Brady Securities recommended your firm without qualification, and that's good enough for me. Do we have a deal? White accepts the new account but does not disclose the firm's referral arrangement with Brady Securities. So if this is the case, this would be a violation. An investment consultant conducts an independent and objective analysis of the investment managers for a pension fund and selects the best one. Subsequently, the selected advisor makes a payment to the consultant. Again, this will be a violation, or this must be disclosed. If not disclosed, then it will be a violation of the standard of referral fees. The last standard talks about responsibilities as a CFA Institute member or a CFA candidate. So standard 7A will talk about conduct as members and candidates in the CFA program. So members and candidates must not engage in any conduct that compromises the reputation or integrity of the CFA Institute or the designation or the integrity, validity or security of the CFA exams. So members must not engage in cheating on the exam, reveal anything about the broad or specific topics tested, content of exam questions or formulas required or not required, not following rules and policies of the CFA exam, giving confidential information to candidates or public, improperly using the designation to further personal and professional goals, misrepresenting information on the professional conduct statement of the CFA Institute Professional Development Program. Members are not precluded from expressing their opinions regarding the program. So saying that CFA Institute charges a very high fees just for conducting an exam, why do they need to charge such a high fees, is not a violation of the standard. You can express your opinion, but you must not reveal confidential information about the CFA program. Candidates who violate any of the exam policies, calculator, personal belongings, have violated the standard. Members who volunteer may not solicit or reveal information about questions considered for or included on a CFA exam, about the grading process or about the scoring of questions. Ashley Hawking is writing level 2. After completing, she immediately attempts to contact her friend in Sydney to tip him off to specific questions on the exam. Will be a violation. Jose Ramirez is a consultant for several small companies that are seeking greater exposure to investors. He is also the program chair for the Institute Society. To the exclusion of other companies, Ramirez only schedules companies that are his clients to make presentations to the society. Again, this will be a violation. All companies should be given a chance to protect or to present in front of the society. A member who is an exam grader discusses with friends the guideline answer and the relative performance for a specific question. Violation. Similarly, 4, 5, 6, 7 are all examples of violation. I'm sure that Bayes formula was not on the level 1 exam this year, or I'm glad, are all violations. Telling that FRA came or giving any hint about any portion of the exam will be considered a violation. Standard 7B talks about reference to CFA Institute, the CFA designation and the CFA program. While referring to the CFA Institute, the CFA designation or candidacy in the CFA program, members and candidates must not misrepresent or exaggerate the meaning or implications of membership in the institute, holding the CFA designation or of the candidacy in the program. Do not overpromise individual competence. Because I am a CFA charter holder, I will give you 15% CAGR is an incorrect statement, will be a violation of your standard. Do not overpromise investment results. Members must satisfy these requirements to maintain membership. That is, sign the professional conduct statement annually, pay CFA Institute membership dues annually. If they fail to do this, they are no longer active members. About using the designation, do not misrepresent or exaggerate the meaning of the designation. Referring to candidacy, please note there is no partial designation. There is no CFA level 1 or I am a CFA level 2. That means nothing. It is acceptable to state that a candidate successfully completed the program in 3 years if they did, but claiming superior ability because of this is not permitted. The Chartered Financial Analyst and CFA marks must always be used either after a charter holder's name or as adjectives, but not as nouns in written and oral communications. Make sure that members and candidates firms are aware of the proper references to a member's CFA designation or candidacy, as this is a common error. So a lot of times the firms will not be aware of what is the proper usage, so you should inform them as well. An advertisement for AZ Advisor states that all of the firms are charter holders and all pass the examinations on their first attempt. This is fine. Problem will be if the advertisement prominently links this fact to the notion that AZ's mutual funds have achieved superior performance. That will be a violation of the standard. Again, if you have not paid your dues and you have not maintained membership, then you cannot use the CFA after your name. A member puts the CFA logo on his letterhead, his business cards, and the company letterhead. So on your letterhead and on your business card is alright, but on your company's letterhead or on your company's business card, you cannot additionally put the CFA logo. So that was about the review on the code of ethics and the guidance for the standards. Please note that reading the code and reading the guidelines will not help you so much on the exam. So you must try to explore different cases and try to see what can potentially be asked and what kind of questions can be formulated so as to get a sense of what the institute considers ethical and what the institute considers unethical. Do not ignore this section. It may be easy, it may not be as quantitative, but it is definitely one of the most important sections on the CFA exam. So practice a lot of questions. Make sure that in your practice tests, you're scoring above 70% consistently on this section. Thanks a lot and see you next time.